Hello, folks. Welcome to our day 2 of 3-day Hydra workshop. Our day 2 is gonna be about macro profiles and inversion. So just confirm me if you can hear me loud and clear, and after that we'll start. Good afternoon, Sylvia. It's 2:30 here, and it's a very nice day. It's a sunny day. The last couple of sunny days before winter gets started, right? So I was like outside enjoying the weather. So I just came back home to deliver what I was supposed to hear. Thank you, Sylvia, for letting me know. We'll start. I'll wait just 2-3 minutes more for a couple more people to join. I'll give them time as we are supposed to start at 3, but I'm gonna start at 2:30. Mr. Man is saying, could you do a quick trade breakdown of Dow trade from Friday? On Friday at the end, I'll keep that in mind, Mr. Man. If I forget at the end, and if you're still here, just remind me. I think the mic is good from my side, Vatuan. So if you just check your volume, I believe it will work out. Volume is a bit low. Okay, I'm just gonna increase a little bit. I hope you guys can hear me now. I changed the volume a little bit more. Okay, so let's start, folks. Okay, so today I'm gonna share a couple of profiles with you all. That these are the only things that I look in chart when price is inside macros. Okay, I already shared macro time periods in our day 1 lecture. So today I'm gonna share the profile of like the whole market structure that happens and what I look for inside this macro time period. In day 1 I shared the setups with breaker, right? So we'll also be looking for breakers in our market profile. Plus today I'll share another entry model with you all, inversion. Okay, in our day 1 we already talked about a couple of inversion setups with breaker, but today specifically we'll be talking about how to take entries by using failed fair value gaps. Okay, this is gonna be different from what ICT is already teaching in his mentorship and on free YouTube. So I hope you guys will find it informative and educational. Thank you, folks. So let's start. So this is our day 2 of macro profiles and inversion. In our day 2 topic, I'll be talking about 3 topics. Okay, so the first one is gonna be AMD cycle at macro. I'll be sharing the complete market structure of what I look for, only the high probability condition. Okay, and the market structure that I'm about to share with you all is gonna repeat every single day. Okay, it's very easy to look at. If you just go on your own chart after I'm done sharing the profiles, review Friday, the week before, and the even months before. As long as you want to go back and just look at the macro time periods, like suppose 820 to 840, 920 to 940. We have a couple of macros, right? So the market structure that I'm gonna share with you all here, if you just go on your chart and look at the time intervals, these 20-minute time intervals, you will see the same specific price action repeating again and again. Okay, so our first topic will be AMD cycle, accumulation, manipulation, and distribution. How price does it inside macro, how price generates liquidity, what kind of liquidity price generates before getting inside the macro zones. The second topic is gonna be about macro profiles, high probability market condition. Okay, and the third one is gonna be high probability inversion and the profile to trade using the inversion models. Okay, so these are the three topics that I'm gonna cover today, and that's gonna be all. So let's start with our first topic. Let's discuss something before we start our first topic. Let's talk about AMD. Price repeats some common market structure inside macros. So today we'll see these common patterns, and the six or seven pattern that I'm about to share with you all is gonna repeat again and again as I'm saying it. We will look for three stages of delivery in price action at macro: accumulation, manipulation, and distribution. These are the three phases that will occur inside 20-minute time interval. Okay, I'm only teaching you how to trade inside macros. When price is not trading inside macros, we'll just avoid what's happening. We don't need to know what price is doing outside of the macros. Okay, our setup will form before the macro gets started, but our setup will get activated inside the macro. So these are the three phases. Accumulation, most of the time it will happen before the macro gets started. Okay, so suppose there is a macro 920 to 940. The accumulation of orders, this phase will get started at 9 to 910. Inside this time period, accumulation of orders. Manipulation is gonna happen at suppose 911 to 920 inside the time period. Okay, and the distribution, that's what we expect to see inside macros. Okay, so three phases: accumulation, manipulation, distribution. Is very easy to understand. The way I'm gonna show you all, I believe it's the easiest way to understand market structure. Understanding AMD cycle will give you an idea of how price engineers liquidity. Okay, so we are not going to be covering all types of liquidity today, but we'll cover high probability market liquidities like relative equal highs, trend line liquidity, when price is consolidating, how to trade that. Accumulation, we expect to see it before macro. Accumulation can come in before macro. Okay, so most of the time in high probability condition, you will see that accumulation, this phase is happening before macro is getting started. Okay, price will engineer liquidity, and that's what we will refer as accumulation of orders. Manipulation, we expect to see it at macro. If manipulation is happening inside macro, it's a high probability condition. If there are some conditions when manipulation will occur before macro, and that we will consider as a low probability condition. We are looking for specific things inside time, folks. We have a lot of macros, so if price is not manipulating inside macro, we'll just avoid this macro and look and wait for another macro to start. And the last phase is going to be about distribution. Mostly in a high probability condition happens at macro. Okay, it's not 100% of the time, but most of the time. Okay, so, suppose 80 to 90% of the time in a day, in an intraday session, you will see price delivering liquidity from one swing low to another swing low, one discount PD area to another premium PD area, one premium PD area to another discount PD area inside macros. That's how price delivers liquidity. So these are the three topics that I'm going to cover with market structure, complete market structure. So let's start with our high probability macro profile 1. Okay, this is the first macro profile that I'm going to share with you all. So for that, let's look at the structure. So this is the structure that we are looking at. Price is consolidating here. Okay, we have relative equal high here, relative equal low here, below this swing low. It's just a structure. I'm going to show you the whole market and how this looks inside market very soon, so hang on. This is one of the highest probability market structure that forms at macro. Okay, this condition right here that you are seeing is the highest macro condition. That's why I put it in the number 1 spot, because this repeats every single day. Okay, if you are patient enough, you will see it repeating inside either 1 or 2 macros every day. In this condition, price generates liquidity in a form of relative equal high or low in both sides of the market. Okay, we are not considering what's happening in price before this phase. Okay, here as you can see, price is consolidating, but before price delivered liquidity very nicely. So we are just avoiding what's happening here. We are focusing inside this price fractal, where price generated relative equal high and low in the both sides of the marketplace. High probability in this condition, when price generates liquidity in both sides, okay, relative equal high and relative equal low, is to wait for price to show its hand. Okay, and how will we know the price is showing its hand to us? We will wait for price to deliver liquidity in one side and then target the opposite direction. Okay, so this is what's happening here. We have our relative equal high here, we have our relative equal low here. So when price is in this condition, okay, when price is just accumulating orders right here, we are not looking for anything. We want to see which side of the liquidity price takes first. Okay, so we have our relative equal low here, relative equal high here. So if price is clearing out the first relative equal lows, we are gonna target relative equal highs. It's that easy, that simple. Okay, folks, if price is clearing out equal high first, we'll be targeting relative equal lows. So this model specifically, okay, note it, specifically we'll be looking for this structure to form inside 1 minute, 2 minute and 3 minute. That's where this condition is high probability. I'll be sharing a high probability market structure in higher time frame, but this here, right here, this model is limited to lower time frame, and that's where it is high probability. Okay, so you guys already know that we are ignoring what's happening in price before price accumulates order here. Price generates relative equal high and low. That's what we are looking at. So once price does accumulation, okay, we'll wait for price to show its hand, deliver one side liquidity. So here, as you can see, price went below relative equal lows. So I wrote it here again for you guys to make it easier. If price takes out equal high first, we will target equal low. If price takes equal low first, we will target equal high. As you guys can see, price cleared out relative equal low down here, so we'll be targeting relative equal high from here. Okay, I'll be sharing the entry and all the criteria, managing the stop loss very soon. So in this condition, we have couple of rules. Without these rules, this condition is not a high probability. So what are the rules? The first rule is price have to get support in a bullish condition or resistance in a bearish condition from a higher time frame PDA. Okay, so suppose price is clearing out relative equal lows first. So below these relative equal lows, we'll have to find out a higher time frame PDA. This is a bullish scenario, right? Price is clearing out relative equal lows first, so we are looking for a bullish trade. So on higher time frame, we'll be also looking for a bullish PDA, specifically below this relative equal low. So this higher time frame PDA can be anything. It can be a fair value gap, it can be an order block, it can be a volume imbalance. We just need to see a PDA that is below where price is providing liquidity first. Okay, so if price was delivering liquidity towards relative equal high first, we would have looked for a higher time frame PDA up here. But what happened here? Price cleared out a relative equal low first, right? So we'll be looking for a higher time frame PDA down here in the discount range, because we are looking for a bullish scenario. So what's our second rule? Once higher time frame PDA is identified, we can manage our stop loss accordingly. So why do we need higher time frame PDA? We need this higher time frame PDA to put our stop loss, okay, to manage our stop loss. Below this higher time frame PDA, we can put our stop loss below there. So at what time frame we'll be looking for this higher time frame PDA? This market structure, we are looking for this to happen on 1 minute, 2 minute and 3 minute, and we will consider 5 minute and 15 minute chart as our higher time frame PDA. So that means what? Once you identify this structure forming in 1 minute and 3 minute, it will go to 5 minute chart and it will look for a higher time frame PD area where price is delivering liquidity first. So if price is delivering liquidity towards relative equal low first, it will it will go to 5 minute or 50 minute, then you will look for a discount PD area from where price can get support. If price is clearing out relative equal highs first, you will go to 5 or 50 minute time frame, and then you will look for higher time frame premium PD area, because we will be looking for shorts then, right? Manipulation and distribution must happen inside macro. Okay, so this right here, when price is generating orders, right, when price is generating relative equal highs and relative equal lows, this is what happening outside macro. We are looking for this stop hunt to happen inside macro, and the distribution price went up, clear out the relative equal high. That's what we are looking to see inside macro as well. So let's find out our accumulation, manipulation, and distribution phase here. It's very easy to spot in this scenario, okay folks? So we have our accumulation of orders here until price clears out one side of the liquidity. That's our accumulation phase. Once price goes below these relative equal lows or highs, that will be our manipulation phase. Here in this picture you can see price cleared out relative equal lows first, so this is our manipulation, and we have relative equal highs left. This is our distribution phase. So very easy to understand. Accumulation, manipulation, we are looking for the manipulation to occur inside a higher time frame PD area, and the distribution cycle, we are looking for this distribution to target these relative equal highs up here. This scenario often provides two opportunity. Okay, so the first opportunity that will come is from turtle soup. The second opportunity that will be coming is from the breaker. Okay, now the price did a stop hunt here. I already taught you guys how a breaker looks in our day one lecture. As you can see, as price did a stop hunt here, the up close candle that will be here, and this price leg is gonna work as a breaker. So suppose you missed the entry here, we are only looking for one trade. Okay, if you took a trade here, then we are not gonna be looking for this breaker to work out. If you missed the entry here, because the movement happens very fast, as we are looking inside 1 minute, 2 minute, and 3 minute chart, these are very lower time frame, and you will have to be very cautious how price is delivering, because in seconds price can move from one direction to another, and you will just be like looking at it. So without experience, I believe like it's very hard to execute here. So if you miss the execution right here, you will still have a chance to enter from this breaker. So once price activates this breaker in this condition, we will wait for price to retrace lower. Okay, trade come inside the breaker, the up close candles that will be here, and then move higher. And you guys know the rules when how to spot a high probability breaker. Price will have to go above the last up close candle here, right, close a candle's body above, and then generate a fair value gap here, and that will be our high probability condition. Once price drops down to this breaker, we'll be looking for another distribution phase right up here. Okay, so let's look at it with some market structure, and this is what I consider I shared this market structure is what I consider as one of the highest probability market structure, folks. Okay, this thing repeats every single day, and I managed a lot of trade execution in hindsight. Okay, live trade execution, plus I managed live trades streaming on YouTube by working with this model. So as you can see here in the first picture, we have relative equal high and lows in both sides of the marketplace, and we already know that relative equal high works as a strong buy side liquidity, relative equal low works as a strong sell side liquidity. So I put some note here. When price generates relative equal high and low in both sides of the market, this opportunity provides a plus turtle soup setup. Okay, you will wait and see where price is providing liquidity first. Okay, we are not looking for any trade inside here. When price is consolidating, we are not doing anything. We don't care what price is doing. We will only outline relative equal highs and lows, and then we will wait for price to go either one direction first. Okay, we don't know at what direction price will go, and it doesn't matter. You don't have to know. You will wait for price to show its hand, and once price delivers one side liquidity, you will target the other direction. As you can see in the second picture, the opportunity is here now. Price provided liquidity to one side of the market. Now you can target the opposite direction from here. Once price clears out the relative equal low from here, you will be targeting the relative equal high here. But one very important thing to keep in mind is that you are not just executing here randomly. What do I mean by randomly? You will have to go to the higher time frame to look for that higher time frame PD area from where price can get support. Because remember, we will also have to manage our stop loss, and that's where we'll be putting our stop loss below that higher time frame PD area. So two things to keep in mind: if price is getting support from any higher time frame PD area here, it can be a higher time frame fair value gap, order block, breaker, etc. Okay. Stop hunt takes place at specific macro zones, so keep in mind if this stop hunt is happening inside macro or not. So I already showed you guys, we are looking for accumulation phase outside macro. When this stop hunt is happening, it should be happening inside macro. Okay, these are very specific rules, folks. Okay, this stop hunt must happen inside macro, and only then it will be considered as a high probability setup. So why inside macro? Why not outside macro? So inside macro, that's when price becomes volatile. That's when price delivers liquidity with speed. Okay, in other time when price is not trading inside macro, that's what price does. It accumulates orders most of the time. Inside macros, it does the manipulation and distributes the order. So that's the reason this stop hunt must be happening inside the macros. And as you guys can see, once price clears out the relative equal low, one side delivery, will be targeting the other side right up here, and we'll be putting our stop loss below that higher time frame PD area. So now let's look at this structure on a market profile. So let's remind you guys about our rules once again. Identify strong liquidity, okay, relative equal high or low. The second rule is identify higher time frame PD area for manipulation. At what time price is forming this structure. So this is very important, the last part, because that's where the time is aligned. We'll be looking for this structure to form inside a specific time. Okay, folks, and look at this structure right here. Price generated relative equal high, relative equal low down here. So we identified our relative equal high and relative equal low. Okay, then our second rule says we'll have to identify a higher time frame PD area. So this trade, I actually took it live on, I believe, on this Thursday. Okay, there was a stream on my YouTube that was by the title, I need one more trade to pass a funded challenge. So if you guys go in my stream, in that free stream, and just look for this setup, you will see it. Okay, why am I mentioning about the stream? Because here I didn't identify the higher time frame PD area. If you go in my stream, you will be seeing me identifying the higher time frame PD area and putting my stop loss accordingly right below that higher time frame PD area. So this structure is very easy to understand, folks. We identify relative equal high, then we identify relative equal low. We wait for price, okay, to get inside the macro zones, and the macro zones can be any zones. It can be 820 to 840. If this structure is repeating inside 8 o'clock, we'll be looking for price to do this stop hunt at 820. If this structure is happening at 9 o'clock, we'll be looking for this stop hunt to happen at 9:20 inside that time period. Okay, because we know at 9:30 we are expecting distribution, so that's what is happening here. Price accumulated order generated relative equal high and low. We don't care what's happening here. We are not looking for any setup until one side of the liquidity is getting delivered. So here price delivered liquidity here. Okay, as soon as, so what's the entry criteria? As soon as price hits the higher time frame PTA, that's where you will enter, and that's where I entered in that stream. And as you guys can see, the execution was here and the TP was above the relative equal highs. Okay, so do you guys see a breaker here? As I mentioned in my previous slide, that if you miss an opportunity here, price will also form a breaker with a fair value gap once price is going clearing out the relative equal highs here. So these up close candle right here will be working as our breaker. Okay, and with this breaker, when this breaker will be high probability, when price generates a fair value gap alongside with it. And you guys know what to expect after. Once price hits this fair value gap, we don't want to see price closing any candles body below this fair value gap, because if price does closes a candles body below this fair value gap, this will work as an inversion, and that's what I will teach you guys in our future slides. So as long as price is not closing a candles body below this fair value gap, we can use these up close candle as our breaker. Okay, and put our stop loss below here and execute here, target to R from here. So in this market structure, in this market profile, price always provides two opportunities. The first one is the highest probability scenario, and the second one only when you are missing this entry. Okay, you are not taking two entries together, you're only taking either one or the other one. If you miss this one, then you are looking for a trade to enter with breaker. So where's our AMD cycle here? This is our accumulation phase, right? This is very easy to understand. Where is our manipulation? Right here. Where's our distribution cycle? Right here. And manipulation and distribution, both of these phases are happening inside macro. So a lot of you will be like, Hydra, where's the other market structure, right? There's nothing else. That's it. Okay, that's the only structure that you are looking inside macros. When price is accumulating this order, you will be looking for price to clear out one side of the liquidity, then deliver liquidity to the other side. That's the only thing is happening inside the macro. Okay, specific macros. There are other profiles that I'm about to share with you all, but this is one of the highest probability scenario, and the good thing is this requires no bias, so you don't have to have hold any bias from the higher time frame. Okay, the only higher time frame you are looking at when price is forming this structure is 5-minute and 50-minute. Take note folks, we are looking for this structure to form inside 1 minute, 2 minute, 3 minute. At what time? Inside our macros. Okay, then we are looking for the distribution and the manipulation happening inside the macros, and that's it. That's the structure here, and it requires no bias. Once you identify the higher time frame PTA, that's where you will put your stop loss below that higher time frame PTA, and you will target the opposite direction. And that's how market will repeat the same structure. Okay, there is nothing more to it. That's it, and that's how simple it is. You guys have the specific time periods right now, right? You guys know about all the macros. I already shared about forex macro, stock macro, and the crypto macro. So the newer folks who couldn't find the crypto and the forex macros, just go above, a little bit above in our private Telegram group, and you will find it there. And inside these macro time periods, if you see price repeating this structure, okay, we are not looking for any trade here. Why? Because this interval, this price action is happening outside macro. So when price generated this fair value gap, okay, so a lot of you are gonna be like, okay, price generated a fair value gap, I'm gonna go short here. But this short condition is not high probability here, right? The short happened, but it wasn't a high probability condition. What was the high probability condition? Taking the turtle soup entry from here. And that's how price will repeat this condition. I'll be sharing another example with you all. So what do you guys see here? So previously, in our previous slide, I shared this market structure. Okay, So this is the most common market structure. This price will form when this structure is repeating, this relative equal high and relative equal low structure. But there's another structure that repeats, and this is the structure. What do you guys see here? Price is delivering sell side liquidity, right? That's why price changed its trend and now it's shifted to deliver buy side liquidity. So what's happening here? Do you guys see relative equal high or low? So let me mark that for you. We have relative equal high here, right? We have relative equal high here, then we have relative equal low here. So what happened here? Price generated relative equal highs, relative equal lows, so both sides of the liquidity in marketplace. So what do we do here? We wait for price to clear out one side of the liquidity. What do you guys see here? Price tapped here below this relative equal lows. We are not executing here. Why? Because we are waiting for price to get inside our higher time frame PD area. So once price gets inside our higher time frame PD area, that's when we'll be looking for a trade setup, and that's where our high probability condition will be happening. So we have our relative equal lows down here. Price cleared it out. We know that once price clears out one side of the liquidity, and if there's relative equal highs above, okay, then we'll be looking for a bullish condition. If price is clearing out relative equal high first and then there's relative equal lows intact, we'll be looking for a bearish condition to form. So our trade setup will be from here, targeting the relative equal highs above, putting our stop loss below the higher time frame PD area. Okay, folks. So I'm not looking at the chat window. Once I'm done explaining each and every macro profile, then I'll be answering your questions. I hope you guys will be patient enough. So this is very simple, folks. Okay, this structure is happening on 1 and 3 minute. Listen to me closely. 1 and 3 minute, and we are looking at these small time frames for this market structure to happen. There's more details to it in our coming slides. I'll be sharing it with you all. So we got our first opportunity. Once price cleared out the relative equal low form here, we entered, we took our trade from this higher time frame PD area, targeting the relative equal high first. Okay, we got our first opportunity. So suppose you missed it. Do you guys see a breaker here now? So once price went below these relative equal lows, we had couple of up close candle here, right? So that's what we had as a relative equal high. So what was the rule? Do you guys remember me saying in the previous slide that when price is activating a breaker in this scenario, we also want to see a fair value gap forming with it. Okay, without this fair value gap, specifically one PD area. That's what I'm saying. We are not looking for a trade from the Reaper. Okay, we are not looking for a trade from the first or second leg, but only from the third leg of the breaker. If you don't know what I'm talking about, first, second, and third leg, I already discussed about it in our first day mentorship, first day topic. Okay, so go back and listen to it and come back to it again and you will understand. So it's very specific. We are only looking for one PD area. Once price clears out the relative equal high, we'll be looking for price to form a fair value gap here. If price don't form this fair value gap, we don't have any opportunity. Once price forms this fair value gap, then and only then we know that these up close candles will be working as a high probability breaker, and we will execute once price steps inside this fair value gap inside our macro times. Okay, and where will be our stop loss? We'll also look at here. Our stop loss will be below the fair value gap that will get generated once price clears out the relative equal highs. Okay, folks. So I'll take you guys back to our previous slide. What do you guys see here? Okay, this is another market condition. The slide that I shared with you now, this is another market condition, but both of these conditions are similar. How they're similar? They both have relative equal high and relative equal low in both sides of the market, right? We wait for price to clear out one side, then we enter here. If we miss this opportunity, then and only then, once price clears out the relative equal highs, we'll be looking for a fair value gap forming at the candle when price is clearing out the relative equal high. The candle that cleared relative equal highs, That's the candle we are looking for, a fair value gap. Isn't it specific? Yes, only one PDR. It never gets any easier than this, folks. And we have our fair value gap right here, and that's the high probability condition. Only if you see this fair value gap forming, that's the only time when you will know that this breaker will work. Okay, why am I putting a rule here? Why am I only referring to this fair value gap? Because as you guys can see, prices both side of the liquidity in marketplace, both are strong liquidity. So price cleared out one side of the liquidity, then price can easily reverse from here after it provides liquidity up here, right? So let's go back, let's come again to our this slide. So what happened here? Once price cleared, price was delivering in a downtrend, right? So we know that our trend is shifted here once price cleared out the relative equal lows, but price can still continue lower from here. How will you know the price is done? Price is not done yet. Once price generates this fair value gap, listen to the rules, folks. The fair value gap will have to get generated at the candle that clears out the relative equal highs. Okay, the candle that clears out the relative equal highs, if that candle has a fair value gap, only then you will consider these up close candle as a fair breaker. Without this fair value gap, this breaker alone will not work. Okay, if it's working, if you are seeing it working, it's only gonna be like 10-20% of the time. The percentage of this in this scenario a breaker working is very, very less, because we already got an opportunity from down here. Once price confirms that it wanna deliver towards buy side liquidity, that it changed its direction. And how will we know that price changed its direction? It wanna continue deliver towards buy side once price generates a fair value gap alongside with these up close candles. Okay, folks, I repeated myself a couple of times. I hope it's clear. We are only looking for a breaker trade with this market structure when price is clearing out the relative equal highs, and at the same candle price forming a fair value gap. So once price forms the fair value gap, we'll wait for price to trade inside the fair value gap, and that's where we will enter, and you will see price coming down here and trading here inside macro times. Okay, folks, this is very specific in market, that when market generates this fair value gap, price will come inside this fair value gap inside a different macro. So we are looking for a trade setup here inside one macro, right? So price will get done somewhere here delivering with one macro, then price will get inside another macro. We are trading 20-minute intervals, right? 920 to 940. So suppose this distribution here happened at 920 to 940, we'll be looking for this distribution to happen at 950 to 1010. So let's look at the writings here. A breaker can form before macro at consolidation phase outside macro, but entry must be inside macro. So what do I mean by that? Our breaker that formed here, when did it form? It formed way before our macro started here, right? This breaker got accumulated or got engineered inside the accumulation phase. Okay, this is our accumulation phase, this is our manipulation phase, and this, all of it, is our distribution phase. So our breaker will form outside macro, but price will activate and make this breaker a high probability when inside macro. So this was it for this first structure. We have our accumulation, manipulation, and distribution. If you guys have any questions, feel free to ask me, and I'll love to answer it. What's your average win rate on 2-hour trades? So average that I get, it depends on month to month, week to week. So on average, I get like 60 to 80% of the win rate. But remember, folks, my win rate is not gonna be your win rate. I trade these market profiles specifically, okay? But I have my experience behind me, okay? So at first, when I started, I didn't execute it by following these profiles. So that time my win rate was around like 30-40%. I was losing very bad. I was blowing account. So once I learned about this market structure, once I found it out in charts that this market structure get repeated inside time again and again, my win rate got increased highly. Okay, 60 to 80%. That's what I average each month. Okay, it's not specific that this month I'll be like doing 80%, but on average I do 60 to 80%. So I can give you a guarantee that if you're following what I'm saying rule by rule, and you are only looking for this scenario to happen inside macros, you will do the same 60 to 80%. And it's very easy to spot, folks. Okay, you don't need to learn anything else for this market structure. You don't need to learn any bias. Okay, go on your own chart. It doesn't matter what chart you are looking, forex, stock, crypto, just go inside the specific time periods that I shared with you and look for this structure happening. So EM is asking, what do you base your first entry on? So the first entry that I'm taking is based on price clearing out the relative equal lows, then price hitting the higher time frame PD area. Go back and listen to me again. I told you guys that we are only executing once we identified the relative equal lows. Okay, once price clears out one-sided liquidity, only then we are looking for a higher time frame PD area, because we don't know which side will price clear out first. Price can clear out relative equal high first, relative equal low first. So there's no point of judging or analyzing chart before price does it. Once price clears out the relative equal high or relative equal low, that's when we'll go to 5-minute and 50-minute chart, and we will look for this higher time frame PD area. Okay, below relative equal low, if price is clearing out relative equal low first, that's when we'll be looking for a bullish PD area at the discount in 5 and 15-minute chart. If price is clearing out relative equal high first, we'll be looking for a discount PD area on 5 and 15-minute chart. I hope it's clear. It's very easy. Jai is saying, so price will enter a higher time frame PD area at 20 to 40 macro, then market structure shift and retracing breaker or fair value gap generated 50 or 10. So we are not waiting for a market structure shift. Do you guys see any market structure shift here? Yes, it happened way up here. But we already know that price shifted its structure when price cleared out the relative equal lows from here. Okay, this is advanced theory on market structure. You don't need to know. You don't need to like outline the general market structure shift to know that price changed its trend. You will know that price changes trends once price clears out this relative equal low, hits the higher time frame PD area, and then goes up, right? But if you are very new and you still want to be safe, there's nothing wrong to wait once price comes up here. But it's very easy to spot in price, folks. Okay, I'll be sharing the execution videos with you all, so you guys will understand that this structure repeats. And I'm just saying to you again, we have a private Telegram group, right? So go on your own chart once I'm done delivering the lecture, and just specifically, you don't have to look at higher time frame or anything. Just look at this 20 to 40, this 20-minute macro intervals, and look for this profile, and come back and tell me that you couldn't find any price action that is similar like this inside any single day. Every single day inside macro periods, this will be repeating. In the breaker entry, the low was sweep where we placed the stop loss. I don't know what you were asking me. In the breaker entry, the low was sweep where we placed the stop loss. This low, we are not putting our stop loss below here. What are you guys doing? Are you guys not listening to me carefully? What did I told you guys about managing stop loss here? We are putting our stop loss below the fair value gap that gets generated once price clears out the relative equal high. Okay, we are not putting our stop loss this time below the breaker here. We are putting our stop loss below the fair value gap that gets generated. Is it clear? In this market structure, this market structure is very specific. We'll have to identify relative equal high and low in both sides. Okay, once price clears out one direction, we'll go to 5-minute and 50-minute chart and we'll look for a bullish or bearish PD area. Once price taps inside this bullish PD area, we'll drop down to 1 and 3-minute and we'll execute here. We'll put our stop loss below. We'll be targeting the relative equal high here, and this breaker is not a high probability here without this fair value gap. So I'm saying it again. Once price clears out the relative equal high here, you want to see price forming a fair value gap at the same candle. Once price forms the fair value gap here, only then you are looking at these breakers. Only then these breakers are high probability. And you are not putting your stop loss below the breaker, but below the fair value gap. I hope it's clear. Now let's move to our second macro profile. Okay, the first one that I shared is very easy to understand. Even to me, that's what I believe. Like even if I'm explaining it to a very beginner, he will understand the first profile. The second profile will contain market, like more in-depth market knowledge. So let's start. So what do you guys see here? We have an accumulation phase here, right? Then manipulation somewhere here, and the distribution towards buy side liquidity. So what are we looking at here? We are looking at market maker sell and buy model phases. Okay, the way I'm gonna teach you market maker buy and sell model here is way different than what other people teach us. Okay, what other people sees and how other people look at this market maker buy and sell model. The way I use it is very simple, just the way I shared the breaker structure, just the way I shared our high probability macro profile one. This will be very easy and simple to understand. So the first profile, the first phase in our market maker buy model. Okay, here we have a market maker buy model. So in this market maker buy model, we'll have the first phase as a consolidation. The second phase will be the first stage of distribution. I'll explain a lot more about this. Okay, just wait. Then we'll be looking at the second stage of distribution. Our last profile will be smart money reversal, smart SMR. Okay, so what's the high probability condition here? The high probability condition is second stage of distribution. Okay, and we'll be talking a lot more about this. So let's focus here. We have an original consolidation here. Now price breaks out of this consolidation, goes above, retraced back to this original consolidation before expanding higher, and this is what will be referred to as a first stage distribution. In our second stage distribution, okay, in first stage of distribution, we are not looking at any stop hunt here. In our second stage of distribution, we'll be looking for a breaker forming. In the market, I got a lot of questions, like, from my day one lecture, is that at what market condition in a market maker buy and sell model we'll be looking for a breaker. So the question is getting answered today in the second stage of distribution. Now, okay, what do you guys see here? We have a low formed here, then a lower low, then price went above. We have our up close candle here that is working as a breaker. Price closed the candle's body above the breaker, retraced back to the breaker. Our expansion happened. Price hit a higher time frame premium or premium PD area. Then the market reversal happens. Okay, so we are not looking for anything here. This phase is already happened in price action. What we'll be looking for, our high probability condition is gonna be this phase. Okay, the phase that is about to happen. This is already happened, the market maker buy model. Okay, now we'll be focusing inside market maker sell model, and we already know the market maker phases. In our first profile, we'll be outlining a consolidation phase. In our next profile, we'll be outlining the first stage of distribution. So in first stage of distribution, we'll have a single low. There's no stop hunt. Okay, we are looking for a stop hunt and a breaker forming in the second stage of distribution. Once I show you guys the actual chart, it will make way more sense than just look at the market structure right now. Clear your mind, just focus here. Okay, just stop thinking about what you look at chart every single day. It's not gonna be same as what you were seeing, but it's gonna be different, but easy to understand once you clear your mind. So are we good? We have 4 phases in a market maker buy and a sell model: consolidation, first stage distribution, second stage of distribution, and then SMR zone, smart money reversal. We'll be talking about each and every one of these step here in our further slides. Okay, the high probability condition here is the second stage of distribution. We have a low here because that's where our breaker will form. Here we'll be focused at the second stage of distribution after SMR. Okay, so we don't know when this is happening, but we will know what is coming in the marketplace once this smart money reversal is happening. Okay, once this smart money reversal is happened. So once this smart money reversal happens, we'll be looking at second stage of distribution. So let's outline our second stage of distribution. So why am I putting so much importance into second stage of distribution? Because the second stage of distribution has a stop hunt, often generates high probability breaker. That's where our breaker will form. Often delivers liquidity in a low resistance. So from this, once price forms a market structure like this in the second stage of distribution, a low and then a lower low, these up close candles becomes our breaker. Very easy to understand if you understood everything from my day one. Okay, so once price completes this market maker buy model, we will look for a market maker sell model to happening and contain each and every phases that it did here. Okay, but we'll be focusing inside the second stage of distribution in the new market cycle. Is it clear, folks? Our market structure, our smart money reversal happened here. Okay, we don't have to know from where price will reverse. We don't have to know anything that is happening here. We are focusing at the second stage of distribution once the first stage of distribution happens. Okay, so price generated a breaker here. Do you guys see it? High, a new higher high. So these down close candles becomes our breaker. So price goes below this breaker. That's when price is retracing back to this breaker. This is our first stage of distribution. We are not looking for any stop hunt here because a stop hunt already happened here. A stop hunt will happen in the second stage of distribution. So price came down, right? Formed a new high, low, new higher high. Then these down close candles becomes our breaker. And this is what we will be looking for a high probability condition. Second stage of distribution targets relative equal high and low original consolidation. So this, once this happened, okay, once we identified that we have a second stage distribution with a swing high, with a breaker, we will be targeting the original consolidation down here that will be coming with a relative equal lows. Okay, so did you guys understood? Market maker buy model, that's it, folks. This is the market maker buy and sell model with our breaker. Okay, because we are focusing in only one specific model, so we'll only be looking for this one model repeating inside the market maker buy and sell model. There are other people who are teaching market maker buy and sell model, but they are not teaching it with breaker. I'm teaching it with you breaker, and that's why it's looking different. It's getting specific. Other people are looking for every trade setup. They're looking for fair value gap, order block, blah blah blah, and all that stuff. We are not looking for that. We are looking for price to form a breaker in the second stage of distribution. And how it gets easier? It gets easier because we are not predicting anything here. Once price gets done delivering liquidity here, we'll be looking for this in the new market cycle. Price will be doing the first stage of distribution. We are not focusing here. We'll be looking for the second stage of distribution right here. So how will you know that the second stage of distribution will happen here? Every single time, folks. This is the must be condition for a market. Okay, every single time price will form this breaker near to the old second stage of distribution. So we already identified, right? I'll take you guys into the actual chart and we'll look how this forms. But for now, as a structure, know that we have a second stage distribution here in the market maker buy model. We are looking for trade in the market maker sell model, right? So where will we expect this second stage of distribution forming? Near to the previous second stage distribution. So this distribution happened where? In the market maker buy model. So when price changes trend, when price is delivering in a market maker sell model, we'll be looking for this structure to form near to second stage of distribution from the market maker buy cycle. Okay, is it clear, folks? Second stage of distribution is high probability condition for macros. Okay, so this everything here, we are not looking at this, we are focusing at this price leg here that will form near to a old second stage distribution. That's why it is easy to spot, because once you identify the second stage distribution, in hindsight you'll be looking for a new breaker to form near to the second stage distribution in the new market cycle. And this price action, we will be looking for this price action to happen inside our 20-minute intervals that I shared with you all, 820 to 840, then 920 to 940, 950 to 1010. There's a couple of macros, so every macros are 20-minute, and this price action will happen in 20-minute. So this here, okay, you can use this structure on 1 minute, 2 minute, 3 minute, 15 minute, hourly. There's no rules for this structure. You will see it repeating in 1 minute chart, you will see it repeating on daily chart, and that's how you will know that where price will form breaker in a complete market maker buy and sell model. So our last topic here, second stage of distribution will often form near to the previous second stage distribution. So I already talked about this. Once we identify this market cycle, right, because we are identifying and outlining this cycle in hindsight, that's why it gets easier to understand where price will form new breaker, because this already price did it in past, right? And we are outlining this structure in hindsight. So we'll be focusing, once we are done outlining the second stage of distribution in hindsight, in our new chart, in our new market cycle, we'll be looking for a new breaker to form near to the second stage of distribution. I hope it's clear. Now I'll take you guys into the actual chart and I'll show you guys how it looks. So before I do that, do you guys have any question about the structure here? Trust me, folks, market maker buy and sell model, you won't find anyone explaining it easier than this. Okay, I'll be showing you where the breaker will form. In hindsight, you will be marking out these, right? And in future, you'll be looking for a new breaker to form near to the second stage distribution. It never gets any easier than this, folks. Yes, Brianna, we'll be looking for accumulation, manipulation, distribution inside here, inside our second stage of distribution. Okay, this is where we'll be looking for this forming. This structure is coming with a breaker, right? We have a low here, lower low, these up close candles becomes our breaker. This condition is specific, I'm just showing it to you as an example. This is gonna be happening in the second stage of distribution. So suppose it's a market maker buy model, okay, and it already happened, this second stage of distribution already happened. You will look for the same condition to repeat when price is distribution liquidity in a new market maker buy or sell model, the same one. And the benefit is this structure will form again near to the old structure. So I hope everything is clear here, right? So now let's go to the actual chart. So what do you guys see here? Just remember the phase. We have 4 phases: consolidation, first stage of distribution, then second stage of distribution, and the last one is smart money reversal, right? So we'll be looking for all of this in hindsight in previous market cycle. So what do you guys see here? This is a market maker sell model. So market maker buy model is yet to happen, right? So what we'll be doing here, we'll be outlining 4 market phases in hindsight in this market maker sell model. So we have our first phase, original consolidation, right? Then what's our next phase? First stage of distribution. Where did it happen? Right here. Once price breaks out from this original consolidation, okay, we don't know where price is going, and we don't care what's happening here. All we care is gonna be what's happening here, okay? And we'll talk about this. So this is our first stage of distribution. Once price goes below this original consolidation and then retraces, as soon as you see it, this is our first stage of distribution. And don't worry about it, okay? You are not spotting it live, you are spotting in hindsight. And that's why it will become easier when you are trading live in this market condition. Now let's spot our second condition, second stage of distribution. Now in first stage of distribution, we are not looking for a stop hunt, right? In the second stage of distribution, we are looking for a stop hunt plus a breaker to form. Do you guys see a stop hunt and a breaker in a second stage of distribution here? This is our second stage of distribution. We have a high here, right? Price delivered liquidity after the first stage of distribution. That's what we expect. Then price retraced higher, and now we know that price is doing a second stage of distribution. We'll be looking for a stop hunt to happen, and that's what happened here. We outlined it, we marked it, and now when price is coming here, we'll be looking for this same structure to repeat here, okay? And we were able to identify our first stage of distribution, our second stage of distribution. Now we'll be outlining the smart money reversal zone. This is our smart money reversal zone. This is where the trend shifted, okay? So it goes back to the original thinning again. This is our original consolidation, accumulation of orders. Price broke out from here, right? So this becomes our first stage of distribution. So this is our first stage of distribution. Now we are not looking for anything to happen here. We are letting this go and happen in price, okay? We are focusing inside the second stage of distribution that comes with 2 rules. It will have to form near to the previous second stage of distribution, okay, right? Plus it will have to have a stop hunt. Without a stop hunt, our second stage distribution is not a high probability condition. So do you guys see a second stage of distribution here near to this old second stage of distribution? Do you guys see a stop hunt? Now this is our second stage of distribution. Now look close. Where did it happen? Near to the previous stage of second distribution from this market cycle here, right? So isn't it easy? Isn't it getting easier? All of this you are outlining in hindsight. Now only thing you are waiting for price to happen is price to form a first stage distribution. Next, once price goes near to the second stage distribution, you are looking for a new breaker to form. Isn't it easier, folks? Now do you see a breaker here? Here in this condition, we are not looking for any trade setup. So this condition is a low probability condition, right? So every breaker that will form here is a low probability breaker. We are looking for a high probability breaker to form here in the second stage of distribution that is happening near to the old second stage of distribution. And this is where it gets magical. This price action is repeating inside macro. Now let's outline the breaker here, okay? Because some of you, I know that you don't really want to put in the work. You guys, I don't know why a lot of you guys complained about that day one. You guys were like, all I shared is the basic stuff. Day one was supposed to be basic because I'm taking you guys from the basic to the advanced level with a breaker model, right? We are only looking for one model. I'm not gonna teach you how to take trades with fair value gap, with order block. That's not what I'm doing here. I'm only gonna teach you how to take entry with one fucking model, and that's what you are looking. That's it, okay? Market maker buy and sell model. You are not looking for any fair value gap or anything. You are looking for a breaker to form, and where I'm sharing you the rules at second stage of distribution. This stage of distribution, where will it happen? I'm also telling you that near to the old second stage of distribution, right? When will it happen? Inside macro. How will it happen? It will have a stop hunt, right? Just the way a breaker forms. Does anyone ever taught you this market maker buy and sell model easier than this? I don't believe it. Okay, so we have our breaker here. We have a low, right? Then price went below this low. This up close candle right here becomes our breaker. Now here we don't have a rule specifically like in our previous market profile. We had a rule that price will have to have a fair value gap, and only then we are taking this trade. But here we don't have this rule. In day one, I shared couple of breaker condition, right? A breaker comes with a fair value gap. A breaker comes with a fair value gap, a discount, and then a premium. You'll be looking for all types of those setup forming here at the second stage. And what do you see here? Price formed a breaker. Price closed the candle's body above the breaker. Did price retraced back to the breaker again? Gave you an entry. Yes, it did. Now I'm showing it to you in hindsight. Once price drops down, okay, when it's happening live and price is dropping down here, you will have a lot of fucking time to execute here. Okay, trust me, you will have. And where are we targeting with this second stage of distribution? Original consolidation. Now, why am I showing this profile to you all? Okay, because a lot of you are asking me, why am I only teaching you to take 2-hour trades? Now here with this condition, I'm teaching you how to take 4-hour trades, 5-hour trades with this market maker buy and sell model. Is it clear, folks? If you guys have any question about this picture, feel free to ask me before I show you the next example of the same market condition. Dale is saying this is awesome. Never really knew this after 10 months. This took a long time for me to find it out, folks. Okay, so the knowledge that I'm sharing with you all, I know that you guys already know it. It worth way more than $80. Okay, so some of you were also complaining about that. I don't know why. What's happening with you all? But this took a long time for me to understand. Years, okay, folks. It's not months. Me, I'm addicted to these charts. So how did I find it out? By being addicted. Because look at here, I'm not sharing the market maker buy and sell model like other people. I'm sharing it with you by outlining a breaker. Where will a breaker form? How will a breaker form? When will a breaker form? And everything. Isn't it getting easier? Now let's look at our second example. What do you see here? So I'll give you guys 1 or 2 minutes. Okay, I'll go and drink some water because I'm feeling a little bit thirsty. Just try to outline 4 phases. Remember, do you guys remember our 4 phases? Original consolidation, first stage of distribution, second stage of distribution, then smart money reversal. Once that smart money reversal happens, we'll be outlining the first stage of distribution, and then we'll be looking for a breaker to form near to the old second stage of distribution in the new second stage of distribution. So now try to find it out here, and I'll come back in 1 or 2 minutes and I'll share with you all. Okay, folks, I'm back. So I already told you guys that there's we are looking for the first phase here, right? The original consolidation phase, and this phase will happen in two forms. So the consolidation phase will come in two forms, with relative equal high and low and trend line liquidity. Okay, that's the only two form that original consolidation can take. Other than this, there's nothing else, folks. Okay, there's nothing else. Either price will deliver with speed here, okay, near to the old original consolidation, but there's only two forms. In two forms price can take in original consolidation: relative equal high and low, trend line liquidity. I already showed you guys in the previous example with relative equal high and low. Here you guys can see the trend line liquidity, right? So we have our original consolidation in a form of trend line liquidity, plus you can also see it as a relative equal low. Look at these lows, folks, how clean it is, right? Very clean. So where's our first stage of distribution? Once price breaks out from the original consolidation, right, and retraces back to the original consolidation, that is our first stage of distribution. This is here. Very easy to identify, because all we are doing here is in hindsight. We are not predicting anything here, okay? All we are predicting is here. And with this information, our prediction here becomes easier. Now, where's our second stage of distribution? Now, do you guys remember, in our second stage of distribution, a breaker will form with a stop hunt. This is our second stage of distribution, right? Do you guys see any stop hunt here in the first stage of distribution? No. So there's one thing. You will see this is what the high probability condition. A market will repeat this condition 80% of the time. Rest of the 20% of the time that you will see price forming a swing low here. Okay, this is another type of market profile, and I'll also talk about that in our future slides. But in this profile, price is not doing any stop hunt in the first stage of distribution. All we are looking for a second stage of distribution. All we are looking for a stop hunt in the second stage of distribution. That's what is happening here. And where's our SMR? This is our SMR phase, right? Now, we are not looking for anything here. We are waiting for the second phase to get started, right? So we have our first stage of distribution. There's no stop hunt. Do you guys see any stop hunt here? No, just as there's no stop hunt here, right? So we have no stop hunt here. We are looking for a clean stop hunt with a breaker at second stage of distribution. And this second stage of distribution will happen where? Near to the old second stage of distribution. Now see how easy it is to identify a breaker with this when you have this market condition in mind. So this thing is not limited with time, okay folks? The same price action will repeat on daily and even on the macro forms in 1 minute, 2 minute, 3 minute, even on the second charts. And it's very easy to identify, even if you don't have, like, if you have 0% experience with trading, the way I'm showing it to you, okay, go and outline it in your own chart and you will see it. This is how easy it is. How do I know it? Because I was teaching live one-to-one to one person, and he didn't know anything about market structure or anything. So once I showed it to him and I was with him, I showed him, I opened a chart and I told him to outline this same condition. It took some time for him as he was new, but after a couple of time it was very easy for him to understand these market cycles. So we are not looking for a breaker to form here, right? We are looking for a breaker to form in the second stage of distribution, and that's where it formed. We have a high here, then another high. This price action is happening inside the macro, and what price condition will be here? We'll be looking for breakers. The breaker that I showed you guys in day one, that's the breaker that we'll be looking here. Okay, now you'll tell me, Hydra, there's no entry here, right? Now consider this as a higher time frame. Drop down to the lower time frame, you will see a lot of entries forming here. from the Reaper, from the first, second, and third fair value gap, you cannot complain to me that you couldn't find the entry here. Trust me, with experience, every single time you will find the entry here, because I shared a lot of entry criteria with you all in day one, right? There wasn't one, two. I shared multiple entry criteria, multiple structure, multiple patterns that price will repeat here. Now let's look at our last example, and after that we'll be looking at our macro profile 3. This is gonna be our last example from macro profile, the second macro profile. And as you guys can see here, our original consolidation is coming in a relative equal high and relative equal low form, right? Price generated relative equal high here, relative equal low in both sides of the marketplace. Then price came down. This is where our first stage of liquidity is happening. First stage of distribution is happening. Then our second stage of distribution and third stage of distribution will also be looking for that. So we have our original consolidation here, our first stage of distribution. Once price breaks out from the low here, okay, because why am I outlining this here now? Okay, why am I not outlining this as our first stage of distribution? Now who can answer that to me? Because all we are doing is in hindsight here. Do you guys understand this? Okay, you only need to outline where price retraced back before an expansion lower, and that is our first stage of distribution. This first stage of distribution does not necessarily have to happen lower. It can happen inside the first stage of distribution and without a stop hunt. So once you are able to identify that, okay, this first stage of distribution will always form near to the original consolidation. Okay, we have our second stage of distribution here, high, new higher high alongside with breakers. So we have our stop hunt here, a new high form. These down close candles becomes our breaker, and as you guys can see, every single time price is forming a breaker here in the second stage of distribution, it also giving you an entry. Like look at here, price closing candles body below these down close candles, came back up, hit this breaker, and now it's going down. So where's our smart money reversal zone? This is where our smart money reversal zone. Okay, now we'll be identifying our first stage of distribution here. This is what happening. And now our second stage of distribution should happen always. That's a must be condition. Okay, second stage of distribution will always, folks, will happen near to the old second stage of distribution. What do you guys see here? Price went above the second stage of distribution, right? But look close, price did came back to the old second stage of distribution, and that's where it formed a breaker. We have our low here, new lower low that went inside here, right? So you don't necessarily need price to come all the way down and trade inside the second stage of distribution, but because price is also leaving signature that it wanna move towards buy side liquidity. What's the signature? Do you guys see the relative equal highs up here? Okay, do you guys see that? Yes, it's there. Once price is retracing lower, it's also generating relative equal highs right here. So how will you know the price will move higher? Once price comes near to the second stage of distribution, that's when you know the price will be expanding higher, clearing out the relative equal highs here. And the next market cycle that forms, you already know it. We have our liquidity in a form of trend line liquidity right here, right? This is our SMR level. Our second stage of distribution is here. So suppose you missed everything here. Don't worry, once price goes below here, right, price will have a SMR zone here, then price will have a first stage of distribution here. Then once price goes below or trading near to the second stage of distribution, we'll be looking for a new second stage of distribution forming near to this. And once price forms a breaker near to this, we will be targeting this liquidity down here. So here's another thing to understand, folks. Price is leaving this original consolidation liquidity every single time when it's doing the second stage of distribution. Okay, price will not clear out this original consolidation liquidity without a second stage of distribution. It's not gonna happen. There's no market profile that where the second stage of distribution didn't happen. Every single time price will have a second stage of distribution before it clears out original distribution phase, sorry, original consolidation phase right up here, right? As I showed you guys in my previous example, what do you guys see here? Did price clear out these lows first and then form the second stage of distribution? No, it formed the second stage of distribution first and then hunt the relative equal lows. That's why the second stage of distribution is so high probability. Why? Look at the delivery outside of second stage of distribution. Market was choppy, right? Even when price was forming a breaker here, price was choppy right here, right? Price formed a lot of relative equal highs. So if you don't know how to look at market, you will just be, okay, I should be avoiding trading today because market condition is not good. Where market is forming a high probability condition, right? It has a relative equal highs. Price is trading near to an old second stage of distribution. Price is forming a breaker here. Now if you align other ICT knowledge, right, with this, right, we have a fair value gap right here, right next to this up close candle. So this fair value gap is also high probability, but you don't need to necessarily have all the understanding of ICT. If you just understand what I'm showing you here, that's enough. So that's it for our high probability macro profile. This was our second macro profile. Now I'm gonna take you guys into the third macro profile. So this is the whole market structure that I'm gonna share and talk about in market profile 3. What do you guys see here? Before I put the lipstick in, do you guys understand what's happening here? Yes, so as I told you guys when I started the stream, I'll be focusing on teaching you two types of liquidity: relative equal high and trend line liquidity. And price will form this relative equal high and trend line liquidity before macros, and at macros price will clear out the relative equal high and trend line liquidity, right? I already showed you guys the relative equal high, how price forms relative equal high and clears it out in our first macro profile. Now I'll be sharing you when price generates trend line liquidity, how price clears it out. In this profile, we'll focus on trend line liquidity. Before a macro starts, price will engineer three types of liquidity, okay? Relative equal high and low, trend line liquidity, and unfilled fair value gap. So these are the only three liquidities the price will generate before macros. So what do I mean by before macros? When price is accumulating orders, okay? When price is doing accumulation phase. Our accumulation phase is happening when? Outside macro. Our manipulation and distribution phase is happening when? Inside macro, right? So price is, now that we know that we have three types of liquidity that price form outside macro, so this price action must be happening outside macro, right? Because here, as you guys can see, a lot of trend line liquidity is forming plus a lot of relative equal highs. But the main structure here is the trend line liquidity. So when did price form it? Here. This is a must be rule. Price should be forming these relative equal highs or trend line liquidity before macro gets started. And at the macro, we know that this is our accumulation phase, this is our manipulation phase, and this is our distribution phase. And at macro, price will hunt this liquidity, and that's our high probability model. So there are a couple of rules. Now I'll talk about the rules. Price will have to generate trend line liquidity before macro. Okay, so these are very specific market condition, folks, and trust me, if you just go on your trading view, okay, look at this, mark the 20-minute, every 20-minute time intervals, and then look at these 20-minute time intervals. And the profiles that I'm sharing with you, you will find at least one profile. That's all price does other than consolidating. Okay, if price is not consolidating inside a macro, you will see this structure repeating. And I also shared with you that when price is consolidating, how to trade it, right? So here price is not consolidating, rather price is generating trend line liquidity before macro. At macro price will hit a higher time frame PD area for support and resistance. Okay, so once we identify that price is generating trend line liquidity, we will wait for price to get inside our macro zone. Once price gets inside our macro zone, we'll see that if price is trading inside a higher time frame discount PD area, because this is a bullish condition, right? Price is forming relative equal highs. So suppose price was forming relative equal lows, we'll be looking for a higher time frame premium PD area. Just a vice versa of this condition in a bearish condition. This is a bullish example. In our coming examples, I'll be showing you the bearish example, but here this is a bullish condition. So once price forms the relative equal trend line liquidity, we'll wait for price to get inside the macro. Then we will identify if price is trading inside a higher time frame PD area or not. Once we identify that, we'll be focusing, or we'll be looking for a breaker to form here. Reversal from higher time frame PD area towards trend line liquidity. And if we can't identify this higher time frame discount PD area, this trade is not high probability. Our trade idea is happening based on this higher time frame PD area. Okay, once price gets inside this higher time frame PD area, we'll be waiting for price to reverse, and this all is happening inside 20-minute time intervals. Model will form inside higher time frame reversal PD area. So our breaker, okay, where will we look for breaker? We know the price formed our trend line liquidity, and that's what we are targeting, right? But where will we look for the breaker forming? Do you guys know that? We'll be looking for our breaker to form inside where? This higher time frame discount PD area. So listen to me close here. Listen to me carefully. This market structure is repeating on 1 minute and 3 minute, and we are using 5 minute, 50-minute chart as our higher time frame. Once price does this kind of formation, we'll be looking for price to tap inside a 5 or 15-minute discount PD area that will be here. And how will you know that that's the higher time frame discount PD area that price will get reverse, right? That's where macro is coming. So when price is trading inside a fair value gap, suppose there are a couple of fair value gaps in that higher time frame. Close your eyes, you will see it. I know, because we all traders, we are addicted to charts. When we close our eyes, we see the chart. So close your eyes and look at 5-minute chart. Imagine that you are looking at a 5-minute chart. You are looking for bullish PD areas, and now you see couple of fair value gaps, and you don't know which fair value gaps you are looking for. So the first fair value gap is that it will have to be in a discount zone, okay? Because we are looking for a bullish condition here. So the fair value gap will have to be on 5 or 50-minute chart in a discount, and that fair value gap will have to hit inside the macros. So once you identify the potential higher time frame PD area, you will wait for price to get inside the times, and once price gets inside the time, that's the period when you will know the price will use this specific higher time frame discount PD area for reversal. Without this time, nothing is high probability on higher time frame. Stop loss can be below, above the higher time frame PD area. So below when we are looking for bullish trade, above when we are looking for a bearish trade. Okay, below the higher time frame PD area will be the safest condition, the newly generated swing high or low, or accordingly to the entry model. Okay, so this, if you are putting your stop loss below the higher time frame discount PD area, okay, that will be considered as a safe stop loss. But if you are a little bit, you have the experience and you know that a breaker will form here, you can also manage your trade accordingly with the breaker that will form inside this higher time frame PD area. TP at the beginning of the trend line liquidity. So Once we identify the trend line liquidity, where will we put our take profit? Now we already know that where we will put our stop loss. Our stop loss will be below the discount PDRA, right? We can also manage our stop loss according to the setup that will form here. Where will we put our TP? So you can target 2R. In this condition, trust me, you will get 2R minimum. But if you want to follow the market structure, you can put your TP where price started forming this trend line liquidity. Once I show it in the chart, it will make a lot more sense. So now let's take you guys in an example, and this is the example. What do you guys see here? Do you guys see the trend line liquidity? Yes, it is very easy to identify. The trend line liquidity is forming here, right? Price formed a high, low, high, low, high, low, high. So a couple of these, we are not looking for anything here, right? We are waiting for price to get inside the macro or near to the macro. We drop down to the higher time frame, right? We have a higher time frame fair value gap here, the hourly fair value gap. Price came inside the hourly fair value gap. There's no potential setup here, right? We have a up close candle here, we have a low here. So this up close candle is working as a breaker, but price didn't actually give you any chance to enter here. Why? Because price wasn't trading inside macro here. Look at the time period here. In this when price did this price action, look at the time. It happened 8:20 to 8:40. So there was no breaker that formed here, right? But there was a breaker. Look close. We have a high here, then higher high. So this down close candles becomes our breaker, right? We have a fair value gap where? At the Reaper. So this is the inversion. You outline the inversion. Price is trading back to the inversion. That's where you enter. So 8:20 to 8:40, that's the time period when we look for a breaker to form on lower time frame, right? And this is 1 minute time frame, and as you guys can see, price did form the breaker even in this macro. But we are avoiding all this. We are focusing in the newly distribution cycle. So 9:20 to 9:30, at 8:20, from the 8 to 9, price formed this trend line liquidity. When did price cleared out this trend line liquidity? At 9:20 to 9:30. Look at here. So here price didn't give you actually any chance. Why? Because price wasn't trading inside the macro. 9:20 to 9:40. Okay, this is an old example, old chart, so that's why I referred here 9:20 to 9:30. But we now consider our macro from 9:20 to 9:40. Okay, we extend it to 10 minutes more. And as you guys can see, inside this 10-minute interval, price formed a breaker. So price retraced back to the breaker and cleared out the trend line liquidity. Isn't it simple to understand, folks? Now let's go to our second example. What do you guys see here? Price generating continuously trend line liquidity, right? It's very easy to understand. If you put your trend line here, it will look like this, our trend line liquidity. Because price is respecting a trend line. Now on higher time frame, price cleared out the sell side liquidity from higher time frame. Price generated this relative equal lows. You are waiting for price to get inside the macro. What macro? We are not looking for any macro here. Our first macro starts at 8:20 to 8:40. So price did this formation. We know that price will form trend line liquidity when? Before our macro gets started. So we already identified that this macro, this trend line liquidity formed. Now we will wait for price to clear out or tap inside a higher time frame PD area. So this time we are looking at an example with a swing low, right? So we have our higher time frame sell side liquidity right here. Price cleared it out. These up close candles becomes our breaker. What do you guys see here? Did price close the candle's body above the breaker here? No. When did price close the candle's body above the breaker? Look very close, folks. At 8:20 to 8:40. Didn't it? It closed the candle's body above. That's when we know that this breaker got activated. Now, when price closed the candle's body above, it also formed this fair value gap. You either can enter here, okay, or you can also take consideration of this fair value gap. Now, in our coming slides I will teach you how to take entry with this fair value gap. Now, do you guys remember we have 4 cycles in our market maker buy model and sell model? Original consolidation, then first stage of distribution, second stage of distribution, and what? SMR zone. So I'm just gonna talk a little bit about this because it's coming in our future slides. This is our SMR zone, right? This is where market reversed. So in our coming market slides, I'll show you guys that how to take trades from the SMR zone using a failed fair value gap, using inversion. So you guys can also use this fair value gap to take trades. There will always be a chance for you to take an entry, okay folks? We are not worrying about the entry. Once we identify this market structure, that price has trend line liquidity, price cleared out the higher time frame, PDRA, then now price is trading inside the macro. Once we identify all these 3 or 4 steps, our entry is not in our thoughts, because either way, one or second way, we will get our entry. So this was our second example. This is very simple knowledge, folks. We are waiting for price to generate trend line liquidity. We know when price will generate this trend line liquidity before it gets inside our specific macro, right? So we identify price generated trend line liquidity. We wait for price to tap inside a higher time frame premium or discount PDRA. Price did it here. Now we wait for price to form a breaker, right? Price already formed a breaker here. Price activated the breaker when? Inside the macro. Then price tapped inside the macro and expanded higher. Cleared out all the buy side liquidity from here. Isn't it clear? So do you guys have any questions about what I showed you guys here? I'll also show another example before I move to our next profile. So let's move on to our next example. What do you guys see here? So before I showed you guys a bullish condition, right? Now in this profile, I'm showing you a bearish condition. So what's happening here? Price is continuously generated trend line liquidity, right? Look at here. All of this is trend line liquidity because price is respecting a trend line, plus price also generated relative equal low. So we know that relative equal low works as a magnet for price. Now we are waiting for price to get inside the macros. Price got inside the macros, price cleared out the swing high, okay? So here it can be a swing high, it can be a fair value gap, it can be an order block, but it should be, this PDRA should be coming from the higher time frame. It should be a higher time frame buy side liquidity, okay? So price formed the trend line liquidity, price formed another high, then a higher high, cleared out the swing high from here. This down close candles becomes our breaker, and this price action is happening inside ICT macro 850 to 910, okay? And now look how clean it is. Price formed a higher high here, new higher high. So this down close candles becomes our breaker. We wait for price to close a candle's body below the breaker. It did here. Plus price formed a fair value gap, right? So price still have a lot of relative equal lows to clear out. Now in this retracement, price is just retracing to accumulate orders to go lower. And as you guys can see, price hit the fair value gap. Couple of times it gives you a chance of entry couple of times, and then it just moved to lower. So in this condition, where will you put your stop loss? Just as I taught you guys in the day one, okay? It depends on what condition is price presenting here. If price is presenting a fair value gap like this, you can put your stop loss above the breaker. If price is presenting a fair value gap premium, you will manage your stop loss accordingly. If price is presenting a fair value gap or inversion here or at the Reaper, right, you will manage your stop loss according to that. Go back to the day one lectures and you will hear me mentioning about this stop loss management and stuff. Is it clear, folks? So Medina is asking, are macro time windows same for all markets? No, it's not same for all markets. Okay, it's same. What I'm sharing here is applicable on stocks, but we have different macros for forex and crypto. So we are done with our high probability macro profile number 3. Now we'll be moving forward to number 4. And before I do that, let's share another example. Okay, let's make it a little bit more clear, because these are the only conditions that will repeat in price, right? So if these conditions are repeating, you should be understanding these conditions clearly. So we have our high probability macro profile, the same profile again. Now look at here. Okay, what's happening here? We have our trend line liquidity. Isn't it easy to identify? Okay, and when price is generating this trend line liquidity, this trend line liquidity is getting generated before our macro. Now price is generating this trend line liquidity. We wait for price to get inside our macro. Now in this condition I'm showing you, you don't have to use in this condition any higher time frame. Okay, if you don't want to use any higher time frame PDA, it's okay. Once you identify how price is generating relative equal highs or lows, look at the price lag. Here will be our OTE, right? And we have a fair value gap right here. In our coming slides, I'll teach you guys how to take entries by using this fair value gap. Just for now, know that you can also execute from this fair value gap. And this is a very specific fair value gap. It's not like I'm just marking one fair value gap and I'm seeing it right now. In hindsight, I'm telling you, once I talk about this, it will make way more sense, folks. Okay, trust me, this is one of the highest probability inversion model. This is an inversion model, inversion macro profile. I'll teach you guys it soon. So price generated liquidity here. Price came down inside a discount PDA, right? This is a bullish condition because price is generating liquidity where? In a form of relative equal high. So this is a bullish condition. Price came down, formed a low here. So now look, every single example that I showed you guys, once price hit the discount PDA, only then it formed the breaker, right? So you can either take entry from here based on OTE or from this inversion fair value gap that I'll teach you guys, or you can wait for a breaker to form. Do you guys see a breaker here? We have a low here, we have a lower low. Now you'll tell me, okay, Hydra price didn't give me any chance to enter here. Now wait, price did retrace all the way down to the breaker again. Look close, folks. We have our low here, right? Let me see if I can zoom it in. Yeah, I can zoom. So we have our low here, right? Price went below this low, new lower low. So these up close candles becomes our breaker. So what do you see here? Once price traded towards buy side liquidity with speed, there's no way you are entering here because it's too speedy. It's happening way too faster. But price did generate a fair value gap here, right? And price did give you time to identify the fair value gap. You can tell me, okay, Hydra, it was too fast for me to identify. Now look, 1, 2, 3, 4. This price action is happening on 1 minute chart. So you got 4 minutes before price came down inside to this fair value gap near to the breaker. You got 4 minutes to execute. Now once price came down here, you guys already know what to do. You see the fair value gap, you execute here, okay, and you put your stop loss below the breaker here, and you target the beginning of the trend line liquidity. Now is it clear, folks? Naresh is asking how we handle the 9:30 market manipulation if it's happened before. If we were for stop hunt, or what can you explain? Okay, Naresh, I don't understand what you were saying, but this will happen inside macro. There's no way that this is happening outside macro. Okay, if this is happening outside macro, I'm not saying like it's 100% that this will happen inside macro, but this is high probability. When it's happening inside macro, only then you are taking it as an entry. Now don't get greedy. If you don't see this formation happening inside one macro, we have multiple macros throughout the day. Okay, if this is a very specific setup, folks, look at here. Price generated relative equal highs in a form of trend line liquidity, right? Price came inside, dropped down to a discount fair value, sorry, a discount PD area. Then price formed the breaker where? I'm also telling you where price will form the breaker. Near to the discount PD area, inside the macro time periods. Okay, it never gets any easier, folks. Then price showed you a very clean breaker pattern. Okay, low, new lower low, up close candle becomes our breaker with a fair value gap. Price retrace back to the fair value gap. That's where you enter and target 2R. Isn't it easy? Are there also macro times for gold? Am I talking about gold? Did you ever heard me talking about gold? Okay, folks, I don't trade gold. I don't have any idea if there's any macros on gold, and I'm not talking about gold. So what I'm talking here, focus on this. Suraj is saying how to identify manipulation versus distribution. Distribution is happening inside macro. Okay, manipulation is happening outside macro. So I believe you missed my first lectures from day 2. So go back to this stream and listen to it again. You will see me mentioning all the stages: accumulation, manipulation, and how it happens. So now let's go to our next profile. Oh, okay. So before I do that, I have a couple of notes here. High probability inversion forms at the SMR zone. So I told you guys that I'll be talking about this fair value gap, specifically this inversion fair value gap in our inversion model. Inversion at SMR zone can be used to confirm market structure shift. So this inversion, we can use it to confirm market structure shift. This is coming in our later slides. So now let's look at market high probability macro profile number 4. So in this profile, this is what we are looking at. Okay, now we don't have a trend line liquidity here, right? But we have clean swing highs. Before I told you guys when prices, do you guys remember our first profile? There I shared how to trade when price is consolidating. In our second profile, I introduced to you market maker buy and sell model. In our third profile, I shared how to trade when price is generating trend line liquidity, right? Now in our fourth profile, I will teach you how you can trade when price is generating relative equal highs and lows. All of these conditions, folks, will repeat inside each and every macro. Okay, the thing is, I don't know at what macros price will present this, but there's a way to know. Okay, what's the way? These liquidities, because this accumulation is happening outside macro, right? So inside macro, price is doing our manipulation and distribution. So we are outlining our targets in hindsight. Price already presented our target. Now we have our target. We are waiting for price to hit our discount PD area. Then we are waiting for model inside macro. Then we are waiting for distribution. Now let's look at this phase here. So once price generates relative equal high, right, and drops down, and we have this relative equal high intact, we'll wait for price to hit a higher time frame key level. Okay, this key level is a higher time frame PD area. So once price hits this higher time frame PD area, we'll wait for price to get inside the macro, and then we'll be looking for this condition here. But in this condition, there's another thing. In our market maker buy and sell model, I told you guys that in our first stage of distribution, we are not looking for any stop hunt, right? But I also told you guys that price can do a stop hunt in the first stage of distribution. So what will you do when price is doing that? So that's what I'm gonna teach you here now. So do you guys remember the 4 phases? Original consolidation, first stage of distribution, second stage of distribution, smart money reversal, right? Then we have our first distribution here. Now what's the difference here? Price came all the way down and cleared out the first stage of distribution swing low. In our previous slides where I introduced to you the market maker buy and sell model, there was no stop hunt. We didn't see the second stage distribution going below the first stage distribution, right? But this time our second stage distribution is going below the first stage distribution. That's what we'll be looking at. In this profile, we are focusing at SMR, at what time reversal happening. We will also focus at the first stage swing low to get taken out by second stage swing low. In this market profile, our first stage distribution low is getting taken out by second stage distribution, okay? That's why I marked it as a high probability macro profile. And let's look at this. We have our first stage swing low right here. Our second stage swing low that formed here. And this is forming inside the macro. So a question can be like, Hydra, how can I know the price will shift here? Very, very nice question, but a very basic question. Your question can be answered very simply. If price is trading inside a trend continuation macro, only then in this condition we are looking for a trend continuation. Now, do you guys know about the trend continuation macro? Yes, in the day 1 I shared these time intervals, the trend continuation macro, where price will continue a trend, and now I will teach you at what scenario we'll be looking for price to continue its trend. In this scenario, our target in this profile is relative equal high or low. Before the second stage distribution, market will generate more equal highs, and this will work as extra confirmation in our trades. So there's another way to know that market will not continue its trend here, rather it will reverse. The way is that price will generate relative equal highs before it clears out the first stage low. Now I know that it's sounding a little bit more complex compared to the other models, right? But trust me, once I show you guys the actual chart examples, it will become much more sense. So we can execute here once price clears out the swing low right here, or we can wait for a breaker to form right here after the second stage, after price clears out the second stage low. Sorry, after price clears out the first stage low with second stage distribution, second stage manipulation right here. So let's look at our example. This will make it a lot more sense here. So what do you guys see here? We have a SMR zone, right? So before we do that, we are outlining our targets. We have relative equal highs up here. Do you guys see it? Price formed a couple of relative equal highs, but didn't go above this swing, old swing. Price came all the way up and then went lower, right? Price hit this discount PD area, and that's where our smart money reversal happened. So we were able to identify our smart money reversal. Now our first stage of distribution is happening here. Now in this market structure, okay, we are looking for price to clear out the first stage swing low by the second stage swing low. What do you guys see here? Price came all the way down, cleared out the first stage swing low, but not going below the SMR zone. This SMR zone should hold, okay? We are not executing right here. That's the main magic of this market structure, because market is already showing its hand to us, and once we identify this condition, only after then we are executing. And this right here is happening inside our execution is happening inside the macros. So our SMR market smart money reversal happened at the discount fair value gap right here. We are able to identify that market changed its shift. Now market went lower, generated a first stage swing low. Market came up, did another stop hunt, went below the first stage swing low. So we are not doing anything here. Okay, we are waiting for price to go above because we are looking for breaker to enter, right? So we have our breaker here, low, new lower low. So these up close candles becomes our breaker. So we'll wait for price to do the second stage swing low. Once price does this, we know that the change in delivery is now completely shifted. We can execute with confidence. And we have our breaker here. We have a fair value gap alongside with the breaker. Price came all the way down. Price activated the breaker. Okay, price went above, closed the candles body above the breaker. Now retrace back to this fair value gap and expanded higher. Yes, so the second stage swing low is also happening inside our trend continuation macro. So if you guys look at the time, okay, here it's happening at 10:50 to 11:10. And do you guys remember 10:50 to 11:10? What is this? It's our trend continuation macro. Price is doing its thing here. So this I will teach as a turtle soup in our day 3. So don't worry about this. Okay, don't think like I'm not gonna teach you. I'm gonna teach you that your $80 is like you will get way much more value than $80 here. So don't worry about that. I'll also teach you guys how to execute here, but not today. We are only looking for to enter with breaker with market maker buy and sell model. Okay, so in our first market maker buy and sell model, we didn't had a stop hunt here, right? In our first stage swing low, we saw that price went up, right? Price formed a second stage distribution near to an old second stage distribution. But this time is different. Why it's different? When price is coming down and clearing out this first stage swing low, this will also work as a confirmation. Now this scenario will repeat like less of the time compared to the other two scenarios that I shared, the trend line liquidity, the consolidation model, and the other models that I shared with you all. Now this one also repeats. So when it repeats, if you see it, if you identify it like this, it's easy to trade, right? Because price is opening its hand. You are outlining the SMR in hindsight. You are outlining the first stage swing low in hindsight. You are outlining the second stage swing low in hindsight. So once price does the second stage swing low, you are waiting for price to reverse and go above these last up close candles, and that's where you are executing. Now does it make sense? Yeah, so there you guys can see the 0.5 level. This is the measurement of this price lag from this high to this low. This is our dealing range, right? So I'm not doing a mentorship here, so I'm not gonna teach you guys about the dealing range and all the basic stuff. But if you are still confused about the dealing range, you will have to wait for me to launch the mentorship. There I will teach like from the A to the X, like from the basic, very, very basic hand-to-hand teaching will be there. But you will have to have the basic understanding of a dealing range. If you understand that, you know that we have our dealing range from this swing high to this low. Our discount, premium and discount level is coming here. And do you guys see how price respected the dealing range here? So when you put everything together, it makes sense. But when you are looking at like one by one, it becomes choppy. But because the thing is that we are outlining all this in hindsight, right? We are waiting for this in live price action. So all of this is working as a confirmation in our price. So let's go and watch our second example. I hope it will make sense. So let's look at our second example. Now here I put in a lot more information than I usually do in example, right? So here's a lot of things happening. What's happening here? We have relative equal lows down here, unfilled fair value gaps, but what we are focusing here, we are looking for first stage swing low to get taken out by the second stage swing, first stage swing high. This is a bearish condition, right? Previously I showed you guys the bullish condition here. So now we are looking for price to clear out the first stage swing high with the second stage swing high. So we have our first stage swing high, price reversed here. This is our SMR zone. Okay, all of this extra information is for you to understand. Okay, I'm not gonna go through all this extra information that market is shifting here. Is for you when you look at these charts alone, so that you understand better. These are the basic stuff. I'm not gonna go all through that. I'm only showing you the market structure that's happening here, the market profile. We are looking for first stage swing low to get taken out by the second stage swing, first stage swing high to get taken out by the second stage swing high. Once price does that, we will know that we have a breaker here. We have a high probability breaker here, but at the same time, price here formed two breakers. We have our first breaker here, we have our second breaker here. And price didn't actually gave any chance to enter the first breaker, but at the second breaker, as you guys can see, once price closed the candle's body below, after doing the stop hunt here, it went lower. It gave you multiple chance to enter. So I also drew the market structure here. Okay, so we have our SMR zone here, the smart money reversal zone, right? Once the smart money reversal zone happen, we'll be outlining our first stage distribution, which is here. Now this first stage distribution will have distribution high, will have to get taken out by the second stage distribution high. Does it make sense? It's getting taken out. So we are not doing anything here, folks. So try to understand that we are not doing anything here. Once price does clear out the first stage swing high with the second stage swing high, only then we are looking for these down close candles. And that's when we will know that this is our high probability setup. Does it make sense? So you guys can ask me questions about this macro profile if you have, before I move to our our next macro profile. Okay, Jai is asking, are also a reclaimed breaker those two down close candles near 1045? Okay, are you talking about this chart, J? 1045, let's see. Oh, I think you were talking about the last one. Yeah, so we are not looking for any reclaimed breaker here. Okay, I told you guys that we are looking for the first stage swing low to get taken out by the second stage swing low once we identify the smart money reversal. Once price does that, we will know that these up close candles that are here will be working as our high probability breaker. AMCO is asking, where is the entry and the stop loss in this particular case? Our stop loss and entry, I already told you guys about this, because I'm not teaching you guys a new PD array here to enter. This PD array I already taught you guys in the day one, and I taught you guys how to manage your stop loss with this. Okay, we have our fair value gap forming here. Everything that formed here is already taught inside day one. So go back to the day one. I believe that you didn't finish the day one clearly. That's why you guys are asking questions like that. Go back, listen to the day one lectures again. You will hear me mentioning about how to manage stop loss here. And once you are done covering the day one, come back to it again. It will make way more sense. So now let's look at the high probability macro profile 5. Okay, so now here we'll be looking at a retail concept, and we'll transform that retail concept into smart money concept. So this is a flag pattern, folks, right? I already believe the folks who have experience, we all started with retail logic, and as you guys can see, we have a flag pattern that forming here. We have high, then low, high, low, high, and this is basically price is forming a flag, and that's how retail teach it. So one price breaks out from this flag, you will execute here, right? Once price is retesting, and you will target higher. So this is a high probability condition, folks. Okay, not in this scenario. I'll teach you guys how to what's the high probability scenario here, but this retail logic, trust me, it repeats more often than you can think of. Okay, you didn't know about this pattern before, or ICT specifically don't teach this pattern, but I'm gonna show you guys how to trade this pattern. And once you see it, you will go on your own chart and you will be able to identify it very easily on lower time frame. So retail theory is liquidity for smart money. What they're doing here is not what we are doing, but this will form in chart, folks. Okay, this flag pattern, don't think like, okay, it's a retail theory, so it's not gonna come in chart. It don't exist. It exists. The same theory will form in chart, but we'll see it differently. How? So we have our flag forming here. So what a flag basically is, if you don't have any idea about it, it's a flag, right? Price is trending higher, then it's just consolidating here, right? So it formed what? If we see a flag pattern forming, we will wait for price to take out either one side first and then hunt liquidity in the opposite direction. So just as I taught you guys in the first macro profile, do you guys remember? There I showed you guys how to trade the relative equal high and low. We wait for price to clear out one side and then hunt the opposite direction. The same thing here. But what the retails are doing, look carefully. The retails are not targeting the opposite direction, rather, right, they're executing when price is breaking out of one direction, and they're targeting the same direction. What we will do, we will target the opposite direction. So once price, what's different with retail is that they're taking trades here. We'll look for price to come. Once price clears out the liquidity from here, right, we'll wait for price to come all the way down and then do the retest here. So how will the formation look like? We'll identify the flag, relative equal high and relative equal low. So just like the retail theory, price cleared out the relative equal high. So the retail will be entering here with a stop loss below here, because these are like double, triple bottom. This should hold in retail theory. Price should not go below here, because that's where the retail says to put stop loss. Why? Because that's a strong support level, right? Price couldn't go below this level. It's struggling here, so that's how retail sees it. But what will happen next is that this price will come all the way down, hunt the retail stop loss, and then move higher. Okay, sorry, then continue its trend lower. Okay, so what price is doing is that it's hunting retail stop loss. Right, so what retail will be doing here, they will be entering a trade here, right? And now when they got stopped out, they will be like, okay, now let's take the trade in this direction. Once price goes down here, they will be looking for a buy, right? They looked for a buy here. Now they'll be like, okay, price dropped down to a discount level. Now let's look for a buy again. And price does what? Price moves even lower. That's how it works. It's a very common pattern, folks. The same freaking thing will repeat. Okay, the same freaking thing repeats in chart every single day inside the macro period. So what you will be doing here is when price does this stop hunt, it's our manipulation phase, right? This is our accumulation of orders. This is our manipulation. So accumulation is happening outside macro, manipulation is happening inside macro, right? So this is a turtle soup entry. This is what I'm not gonna teach you today. This is gonna be specifically for day 3, but this also exists. You can take entry here. I'll make it easier for you guys. Now it will seem harder, like how can I take entry here? You can take entry here, but what we are doing here is we are waiting for price to activate a breaker. Do you guys see the breaker formation here? That's the magic with trading with one model. It becomes so simple when you are trading with one model and looking at market with one model, right? Where price did a stop hunt here, right? So these down close candles that are here will become our breaker. So price did a stop hunt. That's what retail don't know. In retail world, this doesn't exist. If you show this to any retail trader, they will think like, okay, this is not a pattern. This is not a common pattern. This is not a high probability pattern. They will not trade it. And that's what we are doing. We are trading it. Plus, there's more logic. It's not like price is just taking buy side liquidity. Then once price comes down here, we are taking trades. No, there's more details. We are looking for a breaker here. Okay. So our last down close candles will work as a breaker, and that's where we will take our trade, targeting lower price. Does it make sense? It's as simple as that. So this is the end of our breakers. Okay, we will not talk about any more breakers in our coming lecture days. We have one more lecture days. I'm thinking about doing another one with you guys. So I believe there will be day 4 too. Day 4 will be basically about your talking about your questions, like what you didn't understood. If you guys want to see more examples, then day 4 will be based on that. Now I'll show you guys or teach you guys how to take entry with inversion. So if you guys attended my day 1 lecture, or if you guys saw the recording, I already shared a couple of inversion model, like how to take inversion, how to take setup when price has in a breaker has an inversion, right? Do you guys remember inversion in the premium lag, inversion in the fair discount lag, inversion in the reaper? Now today I'll show you guys how to take entry without breaker just by using an inversion. So before I do start, I'll take a 1-minute break. I'm just gonna go and drink some water or make a coffee, and I'll come back, okay, and start the lecture. I hope you guys will be patient enough. Just 1 or 2 minutes, folks. Let me know in the chat, folks, what I'm talking and sharing here, does it make sense to you? Let me know in the chat. Okay, I'm back, folks. So our high probability inversion profile, we'll be talking about 2 inversion profiles today, and the next inversion profiles that I'll be sharing, it will come with day 3 because it's specifically related with turtle soup. Okay, folks, so let's look at the inversion profiles. So now we are not looking for any breaker to enter, but we're gonna be looking for to take trades using inversion specifically. So what's the logic here? So we have as you guys can see, we have a price swing here, right? So we have a key level here. So this key level can be a swing high, can be a higher time frame premium PDRA, because this is a bearish condition, right? I'll show you guys examples of bullish, bearish in both conditions, but this here right now is a bearish condition. So the logic is very simple, folks. The way I'm saying it to you, it never gets any simpler than this. Even ICT himself is not explaining this simply. And it's not like it's simple and it doesn't work. It works at the same time. Once I'm done explaining the lectures with inversion, I'll take you guys in the actual chart, okay, without hindsight. I'm gonna show you guys exactly what I taught you guys, how easy it is to spot on actual chart. I'm gonna show it to you all. So we have our key level here. So this key level can be a swing high, a higher time frame premium PDRA. So once price hits the premium PDRA or clears out a swing high, we'll be looking for price forming a fair value gap. Okay, so where will this fair value gap form? When price is clearing out the old swing high or swing low or hitting a premium or discount PDRA, when price is getting inside that premium or discount PDRA, we'll be focusing at the last fair value gap that formed before price cleared out the swing high or tapped inside the premium PDRA. So suppose we have a swing high here, okay? So price went up. This is our last fair value gap that formed, right? So what we will do, we'll wait for price to go below this fair value gap, because this is a bullish fair value gap. And now we are learning how to trade from a failed fair value gap. That means what? An inversion. So for this fair value gap to become inversion, it will have to get failed, right? So how does it get failed? When price closes a candle's body below this inversion, below this fair value gap, that's when it becomes an inversion. And that's a high probability scenario, folks. Okay, once price closes a candle's body below the inversion, at the very next candle you execute with a stop loss above here or above the candle's body. It's gonna depend on the market structure. Okay, I'm gonna show it to you in our next couple of slides, in our next examples, but this is the simple logic. We are waiting for price to clear out an old swing high or low, and before price does that, price will have to generate a fair value gap, right? And once we identify that fair value gap and price clears out the old swing high or low or a premium or hits a premium or discount PDRA, we'll wait for price to go below this failed fair value gap, this fair value gap, and then we'll wait for price to close a candle's body below this fair value gap, and that's when this fair value gap will turn into an inversion. And when price does that, it's one of the highest probability market one of the highest probability market profile that you can find anywhere, okay, folks? Because you can manage your stop loss very, very tightly. You can put very narrow stop loss with this model. A high probability inversion forms after price hits a key level in price. Okay, so what's the key level can be? The key level can be old swing high or low, premium or discount PDRA, and the OT. So there are three things, okay? There are three specific things. This key level can be an old swing high or low. This key level can be a premium or discount PDRA. So suppose this price is hitting a premium breaker, okay, in a higher time frame PDRA. So we are not learning how to take trades on higher time frame, but how to execute on lower time frame. So you saw a higher time frame breaker and you are not executing here. So what will you do? You will drop down to the lower time frame, and the high probability condition is that another breaker will form with the new old breaker. But what if the old breaker doesn't form? This is what you'll be doing when a new breaker is not forming. Okay, once price hits the old breaker, we will expect to see price forming a new breaker near to the old breaker. But if it doesn't happen, this is the condition. This is the fair value gap that we'll be looking for, and this is our entry model. So our key levels are old swing high or low, premium or discount PDRA, and OTE. So let's look at the market structure. This is our key level, right? Price is trading higher. This key level can be old swing high or low. This key level can be a premium or discount PDRA. It can be a fair value gap, order block, a old breaker, anything. Okay, this is just a key level. So once price hits this key level, we'll wait for price to generate a fair value gap here. So this fair value gap is not yet an inversion, because price can easily come down here, because this is a bullish fair value gap, right? Price can easily come down and trend higher. So how will you know that the change in market happened? When price goes below the inversion. This is the advanced market structure shift theory, folks. You don't need a market structure shift here. Am I teaching with breaker? I didn't taught you market structure shift. With anything here, I didn't taught you market structure shift. Everything that I'm teaching here is coming without a market structure shift, okay? We are predicting market structure shift by using this fair value gap. Once price closes a candle body below this old fair value gap, below this inversion, that's when the market structure shift happened. So once price hits this hits the key level, you wait for a fair value gap to get generated, then you wait for price to close a candle's body, just like it did here, candle's body below the inversion, right? And then retrace back to the inversion at the next candle. You are not looking for a deep retracement. What do I mean by that? Suppose price came lower and then did a deep retracement. I'll show you guys examples on that, but that is not a high probability. This is what a high probability is. Price closing candle's body below at the next candle. Look at very close, folks. This candle, when it opened higher, right? It went higher. It traded inside this inversion. That's when you execute. So suppose you missed your entry here. At the very next candle, you will get a chance to enter. So this is our market maker buy and sell model. That's what is repeating here, right? We have our original consolidation, our first stage of distribution. This is our second stage of distribution, right? So now I'm teaching you how to take entries here. If you fail to take any entries here, we have our second stage of distribution forming near to a old second stage of distribution. So market is giving you how many chance to enter or take a trade? Multiple. So that's why when you see me like streaming and trading live in front of you, I never worry about a entry model, okay? Because I know if I the only thing that I need to understand is the market structure, what price is doing now. Entry, I'm not worrying about that. If I miss an entry, there will be more chance, okay? There will be more chance coming in a day, in a week. So now let's look at this in actual chart, okay? So what's happening here is our immediate rebalance. I already taught you guys about immediate rebalance in our day one. So from our first slide, we know that we'll have to identify a key level. This key level can be a all swing high or low, a premium or discount PDRA or a OT, right? So suppose this is a all swing high or low. So what price did here? Price came all the way up, right? Traded, hit this all swing or cleared out the all swing high. Then what price did here? The last fair value gap. We are looking for the last fair value gap. Price came down, closed the candle's body below this last fair value gap, okay? It's this simple, folks. We wait and execute at the next candle, at the next candle, and look how price is, how the candle's bodies are staying inside this inversion, right? So where will you put your stop loss? Above this swing high. There's no way price is going, after price closes a candle's body below, okay? If price is going above this swing high, you are wrong anyway. So your stop loss can be very, very, very slim, right here, okay? With a breaker, our stop loss is a little bit big, right? But with this model, our stop loss is very small. We are executing here at this candle, or suppose you missed to enter at this candle, or suppose you missed here, then you can execute it here. Price will give you multiple chance to enter once it closes a candle's body below this fair value gap. In a bearish condition, once price closes a candle's body below inversion, you don't want to see price going above or closing a candle's body above inversion. This is the most important rule, folks, with this model. Once price closes a full candle body below this fair value gap after hitting a key level, you don't want to see the next candle and the next candle going above, Okay, the wicks can go above. I'm talking about the candle's body. Candle's body should specifically stay inside this inversion, and that's what you are seeing here. This is what I refer to as immediate rebalance, and I already taught you guys what immediate rebalance is and how you take entries with it in our day 1 lecture. And as you guys can see, price continues trend lower. This is our sell side liquidity. That's where we target. You can either trade 2R if you are a very beginner. Okay, if you don't have much experience with these charts, I'll highly suggest you to stay with 2R. And once you are experienced enough, once you are taking like a lot of trades and your win rates are high on a monthly basis, only then you can take like high reward trades. Like this is more than 2R, right? If this condition is repeating in market structure and you are seeing it, this is more than 2R. As long as candle's body is staying below or inside the inversion, is a high probability scenario. I already talked about this, so this is something that you don't want to see price going above. The wicks, okay folks, it does the damage. So it doesn't matter as long as price is closing its candle's body inside the inversion. The wicks, it's allowed to go above, but not above the swing high. If price is doing a stop hunt here again, then you are probably wrong. And if price does a stop hunt again, it's generating another entry model. Okay, so don't lose hope. Suppose you took a trade here, and no trade is 100% winning guarantee, right? So suppose price did a little bit more manipulation, price went above this swing high, then we will have a breaker, right? Once price goes above the swing high, these down close candles here will work as a breaker. So why are you worrying about an entry model? Even when you are losing, price is generating another entry model, right? So let's look at another example. So in our previous slides, I taught you guys about immediate rebalance. We'll be looking for to take entry when price is like doing something like this. Even in the previous slide, I showed you guys that once price closed the candle's body below, we are executing at the next candle. Now I'll show you guys how to take trades by using the same model when price is retracing, doing a lot more delivery and retracing back to the inversion. So this is an example here. We have our all swing high, right? So from the first slide, I'll take you guys back to the first slide. We have our key level. Our key level can be 3 PDRAs, all swing higher low, premium or discount PDRA, and OTE, right? So here we have a swing high, and what do you guys see here? Price cleared out the swing high, and then at the same time price generated a fair value gap here. Now what our rule says, we will wait for price to go below this fair value gap, right, and close the candle's body below here. So this is not an inversion yet, this is just a fair value gap. We will refer to this as an inversion once price closes the candle's body below. Now there's more to it, folks. Okay, we are not just looking for an entry here, you will also have to have target. Do you guys see the target here? Relative equal lows, right? Relative equal lows. This is a very small relative equal low, but this and this are very close. Now what do you see here? In our previous examples, we saw that with one candle price did a closure right below the inversion, but here price is doing closure below the inversion with multiple candles. So this is another scenario. Most of the time, okay folks, you will see price repeating this, but when price is doing this, you will be looking for this scenario. When price is not closing a candle's body, when price is not closing below inversion with one candle, one single candle, you'll be looking for this scenario right here. When price does closes the candle's body below the inversion with multiple candles, you will wait for a retracement. Now in our previous slide, right, we didn't wait for a retracement. As soon as price closed the candle's body below the inversion, we executed the next and the next candle, right? But here, what's the difference? Here price didn't close below the inversion with one candle, but with two candles. So in reality there can be 3-4 candles, it doesn't matter. If price is not going below inversion with one candle, then we'll wait for price to retrace back to the inversion again and then drop lower. If price is closing below this inversion with one candle, we look for immediate rebalance. That means what? We executed the next and the next candle. But if price is not closing a candle's body below this inversion with one candle but with multiple candles, we wait for a deeper retracement. Does it make sense? When do you expect immediate rebalance? Did I answer it? Yes, when price closed a candle, when price closed a candle's body with a single candle below the inversion, that's when we expect immediate rebalance. But what happened here? Price didn't close the candle's body below the inversion with one candle but with multiple candles, right? Now we wait for a retracement back to the inversion, and as you guys can see, this will be your OTE. So suppose you put your fib here to this low, this will also be OTE. If you are putting like other logic with other basic ICT logic, this will make way more sense. We also have another fair value gap here. So if you are just looking at this as a premium and discount like this, so we have our premium here, so this is a premium fair value gap, right? Price did a aggressive delivery here. So let me go back. So aggressive delivery here, there was no bullish delivery here, so we need a bullish delivery here. So what price did after hitting a discount PDRA, right? This is a discount PDRA, this is a discount fair value gap. Price did retrace back to this inversion. So now we know that price will retrace. How do we know? Because price didn't close below this inversion with one candle but rather with multiple candles, right? That's when price does this. This is very specific, folks, okay? When price does this, we wait for price to retrace back to the inversion and then hunt lower. So with this model, do you see how you can manage your stop loss? Very narrow stop loss. So do you guys have any question? If you guys have any question, feel free to ask me. When we don't have an entry with immediate rebalance, we will wait for price to retrace back to the inversion after tapping into a discount PDRA. Okay, so this is what's happening. If price is not showing any willingness to retrace after hitting a discount PDRA, we won't consider taking any new consider taking any new PDRA. Okay, here I made a mistake. Any new entry. Now it makes sense. Okay. Does it make sense, folks? You guys can ask me question if you have any. Okay, Amco asked a very nice question. Does inversion has to be in the same time frame, or we have to shift to lower time frame to see inversion after price has hit the higher level or higher time frame? Okay, so if you spot this price action, what price action? If you see price generated a fair value gap on higher time frame like this, you will drop down to lower time frame, okay, and you will look for a breaker forming here. But what I'm teaching you here is this is forming on 1 to 3 minutes. So there's basically we are not trading on second charts, right? I'm not gonna teach you how to trade on second charts in 3-day bootcamp. It will be included with my mentorship. I'll teach you guys how to take entries on higher time frame. Like in the mentorship, this is just a 3-day bootcamp, okay? I'm talking about 3-day, three different models in 3 days. This is not a mentorship. In a mentorship, you get to know about everything that there is in the market. So these rules are very specific. If you see this in a higher time frame, you will drop down to the lower time frame and you will mark this inversion from the higher time frame. You will look for a breaker forming here inside this inversion on lower time frame. So suppose this is a 4-hour time frame, okay, and this is happening on 4-hour. You will drop down to the 1 minute chart, and you will look for a breaker forming inside this 4-hour inversion. Does it make sense? Now we'll be looking at the inversion profile, the second one, okay? The second inversion profile. This is the market structure for second inversion profile. Do you guys remember me saying that in our smart money reversal zone, SMR zone, will be looking for an inversion, and that's where our high probability inversion will form. So what's our SMR level here? This is our SMR level, right? So we'll be looking for an inversion to form here, or a fair value gap. So this is our SMR. In this profile we'll focus, and this is one of the easiest one, okay folks. So far what I showed you guys, it's easy to spot on higher time frame. So the last one, the inversion profile 1, it's not bound to lower time frame. You can use the inversion profile 1 with lower time frame, with higher time frame, but that one is high probability on lower time frame, but it can also be found on higher time frame. But this one, okay folks, there's no rules. You will see it on lower time frame, higher time frame, exactly the same way. The same way it repeats on the higher time frame, the same way it will repeat on lower time frame. So in the previous slide, okay, let me take you back. When MCO asked the questions like, suppose this price action is repeating on higher time frame on 4-hour chart. So I told you guys, if this is happening on 4-hour, you will mark this inversion, you will drop down to 1 and 3 minute, and you will look for a breaker forming here. So with this model, what I'm gonna show you here, you are not gonna look for a new breaker forming, but the same thing repeating on lower time frame, okay? It will make more sense once I show you guys the chart example. In this profile, we'll focus at the SMR zone and the fair value gap inversion that formed there. The fair value gap and inversion that formed here. So what's the logic? We have our inversion here, right? So the logic is that when price comes inside a old SMR zone, we'll be looking for inversion there, and before price goes below this low, we'll be looking for to take trade by using this fair value gap from this SMR leg right here. Once price closes a candlestick body below the inversion, we'll look for high probability entry right here. Wait, okay, right now I know that it doesn't make sense, or it's getting complex. Once I show you guys the actual chart example, it will make way more sense. Okay, it's the easiest one. We'll look for a new PD area to form in the new distribution cycle near to the old inversion fair value gap from SMR zone. Okay, I'm gonna read it again. We will look for a new PD area to form in the new distribution cycle. That means what? We'll be looking for a new PD area to form here, and this is happening where? Near to the old inversion fair value gap from SMR zone. There will be an inversion. We'll be looking for a new PD area to form here, but our trade idea will be based on this inversion. If a PD area forms here, it will work as extra confirmation, but we don't necessarily need a new PD area to form here. We can just execute based on this. This repetitive high probability scenario will appear every day on stock, forex, crypto. Okay, I'm not gonna show you guys other profiles in chart, but today I'm gonna take you guys on the Dow, and I'm gonna show you guys how this one forms once I'm done lecturing this. So how it looks in actual chart. So first we'll have to identify our SMR zone, right? So this is our SMR zone. And what's our rule? We will have to identify the fair value gap that formed inside this SMR zone. So price have had a buy side liquidity here, price came all the way up, cleared out the buy side liquidity. We are not looking for anything here, okay, but a breaker did formed here, right? We have a high, new higher high, so this down close candles becomes our breaker. Once price closed the candles body below the breaker, the next candle, as you can see, price did give you a chance to enter here, but we are not looking for anything here. We are looking at this inversion that formed at the smart money reversal zone, okay. Specifically here we have our this inversion. We wait for price to close a candle's body below this inversion from the SMR leg. Once price does that, we'll outline it as an inversion and we'll look for price to trade inside here, just like this, okay. It's as simple as this. What's the difference? The previous one that I showed you guys, the inversion was forming here, right? Now we are looking for an inversion here in the SMR lag. So you don't have to know anything what's happening here. What you are looking to know is that once price comes near to the SMR zone, you will be looking for a fair value gap from the SMR leg. So you identified the fair value gap from the SMR, you extend it out on time, and you wait for price to close the candle's body below this old fair value gap. So when price does close the candle's body below this fair value gap, it becomes an inversion. So we already know the inversion. When price closes the candle's body below the inversion, the next candles that price will generate, the bodies of these candles should remain inside this inversion, okay. So the rules, I'm going to share the rules again. Inversion at SMR zone, we have our inversion at SMR. Wait for price to reverse and close, and the close of candle body below the inversion from SMR. So wait for price to reverse. Price did reverse here, right? And close the candle's body below inversion. Price did came down all the way down here, close the candle's body below here, below the SMR. A new PDRA forming near to old inversion. So we have our old inversion here, a new PDRA formed here. Do you guys see the new PDRA? Yes, this fair value gap. A new fair value gap formed near to this old inversion from the SMR leg. So we don't necessarily need it, okay. We can just trade based on this, but if price is also forming a PDRA here, we can also use this as an entry criteria, and this will give us more precision. When price is forming a new PDRA near to the old inversion from the SMR leg, we can execute here rather than executing here inside this inversion. Once price traded back to this fair value gap, we can execute here. We can put our stop loss above here. Once price closes a candle's body below inversion, the next candle body should remain below the inversion. So once price does closes this candle's body below the inversion, each and every candle that will open next, they should remain below the inversion. So this is a chart example from the daily Dow, okay. So on the daily chart on Dow, if we go and look at the daily chart, you will see it right now. So let's look at another example, and before I do outline it for you, I'll give you some time to use your eye to put the lipstick before I do that, okay. I'm just gonna give you guys 1 or 2 minutes. Do it on your own, and if you guys have any questions about this, ask me in the chat. Naz Life, I know bro, you joined later. I already talked about this, okay. SMR zone, how do you identify SMR zone? Go back and listen to the stream from the beginning. You will hear me mentioning how to identify SMR zone. So let's see, let's put our lipstick. So what's our rule says? We'll have to identify a SMR zone first, right? So this is our smart money reversal zone. And now the next thing that we'll have to identify is if there's any fair value gap in the SMR zone, an inversion fair value gap specifically. Do you guys see it? Yes, it's here, right? That's where price changed its trend, and that's where the fair value gap formed. We mark the fair value gap, we extend it out on time. Once price closes a candle's body below, as you guys can see here, price did close the candle's body exactly below this inversion. We are not looking for anything here, okay? We are waiting for price to close the candle's body below the inversion from the SMR leg. Once price does that, each and every candle that's opening here should remain below the inversion. Now you can use this entry, this inversion to take an entry here once price is trading inside. Where can you put your stop loss? Above here. Okay, you can put your stop loss above here, and then you can target 2R, or you can wait for price to form a breaker inside this inversion. And it did form the breaker here. We have a swing high here, a new higher high, so this down close candles becomes our breaker. Extend it out on time, and you will see price beautifully respecting this breaker, plus price formed a fair value gap right here. So if you missed a chance to enter here, price will give you another chance to enter here. Isn't it simple, folks? This chart example is from October 2023, 4-hour Dow. So we have our SMR zone right here, right? So we have another SMR zone right here. This is a smart money reversal zone. Okay, now price is yet to reach all the way up here, but every single time price reverses, folks, there will be a fair value gap. Now, do you guys see a fair value gap, an inversion fair value gap right here? Yes. Do you guys see it? The last one, okay, the last one before price reverses. Did price reverse here? No, price continued trend higher. Price reversed here at this leg. Price closed the candle's body below this fair value gap, right? You extend this inversion, just as I taught you guys in the first model, right? First inversion profile is here. So price cleared out an old swing high, right? In our first profile, I told you guys that price will have to go above a key level. That key level can be an old swing high, a premium or discount PDA, or a OTE. So we have our old swing high here. Price went above this old swing high. We have our fair value gap, right? The last fair value gap before price cleared out the swing high here and the swing high here, right? So we extend this fair value gap out on time, and we wait for price to close a candle's body below this fair value gap. Did price close the candle's body below here? No. We wait for a full body closure. Price did close the candle's body below, here, below this fair value gap. And what do you guys see? At this candle, price retraced exactly at this inversion. Let's look at our last example. Identify the SMR zone here. So did you identify the SMR zone? Yes. If yes, identify the fair value gap. Did you identify the fair value gap? Now, is it an inversion? Now, is price closing a candle's body below? Now, the condition here is different, okay, folks? The conditions that I showed you here is price is not going up after closing a candle's body below the inversion. But in the next example, I'll show you guys when it fails. Okay, how do you trade when price is failing the setup? I'll show it to you. So this is our SMR, right? We have our fair value gap right here. We have multiple fair value gaps in this condition. So which one do you trade? That's a very nice question. You can trade this one, okay? The newer one. In our previous examples, I'll show you guys, there was basically no other fair value gap other than this one, right? And even at this example, there was no other fair value gap. But when price has fair value gap in the new leg, we'll consider this one. We won't consider now this one or anything else here. Now this is the new fair value gap. We'll wait for price to close the candle body below here. So price did close the candle body below. We are executing according with our rules, but what do you guys see? Price retraced higher. That's what will happen, folks. Okay, it's not like every single time you'll see this setup and it will be like 100% what, like profitable. It's not gonna be profitable, but in this example, as you can see, price did give you opportunity here, but it failed. Next time, did price close the candle body again below this inversion? No, it didn't, right? So price went up. Now this time again, price closed the candle body below here, and price gave you opportunity here. Once price, you lost money here, you gained money here again. So this is our another example that I'm going to show you guys, right? We have our SMR leg right here. That's where price changes trend, right? We identify the fair value gap here. We have a fair value gap right here. This one, we identified it as our inversion. Now we wait for price to close the candle's body here, right? Did price close the candle's body below here? Yes, it did. And now look at that. So this one, in this one, price is failing. Okay, price did close the candle's body below here, but price is reversing now. So when price reverses, now I'm going to teach you how to take trades when this inversion fails. What do I mean by this inversion fails? When price closes the candle's body below here, price should continue its trend lower from this level, right? But what do you see? Price did came back up again and close the candle's body above here. So that's what you don't want to see. But if you see it, that's also another opportunity for you. When price is coming back up after closing a candle's body below the inversion right here, that's another opportunity. When price is closing a candle's body again above this inversion, you should know that the market structure shift happened and you were wrong here. And at the very next candle, you can see how price continue its trend towards buy side liquidity. And this right here, we'll use this condition just like before, right? In this condition, price closed the candle's body above the old inversion from the SMR leg. Now we don't want to see price going below again and closing a candle's body below. That we can do the damage. We'll put our stop loss below the inversion from here and we should be safe. And here, as you guys can see, after price gave you multiple chance to enter here, 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 here. So this last up close candle is working as a breaker. This is a low, right? If I zoom in a little bit, this is a low. So suppose this is a higher time frame. So it'll drop down to 1 minute and you will see a perfect low forming here, a low that formed here. This up the up close candle here will work as a breaker. So once price goes above the breaker, you execute at the very next candles. So this is it, folks. This is our day 2 lecture. And before I do close the session, I'll take you guys on the chart of Dow and I'll show you guys the example of inversion profile 2 specifically, okay? So this is our actual chart from the Dow. Now I will look focus on this leg, this price leg here. So where's our SMR leg right here? This is our SMR zone, right? So let me mark that for you all. This is our SMR. Now we wait for we identified the SMR. Do we have an inversion here? Yes, we have an inversion. What do you guys see here? This is, I'm showing you an actual chart. This is Dow on daily time frame, okay? Now I'll show you guys this price leg. Sorry, not this one. Let's drop down to the 4-hour chart. Now let's look at this price leg on from the daily to the 4 hour. So this is our SMR zone, right? This is where price changes trend. Do we have a fair value gap? Inversion. Yes, we do have an inversion right here. Do you guys see what do you guys see here? So now this is, I'm showing you on higher time frame. You can use this narrative to decide your bias. Now the price is trading inside this inversion. As long as price is not going above this inversion, I can know that price is gonna stay lower. Okay, I know I can potentially recognize that price is trending lower. Okay, or price will continue its trend lower. Now let's show you guys a couple more examples. Okay, I'm just showing you randomly. Okay, I didn't outline it before, just a random example. Here, what's our SMR range? This is our SMR range, right? It's this easy to identify on charts, folks. It's this easy. Do we have a fair value gap here? Yes, we do have a fair value gap. We outlined it and extended out on time. Did price close the candle body below here? It didn't. So now we know that price will continue its trend higher. Once price closed the candle body below, right, it did here. We don't want to see price coming back up and going above this inversion again from the SMR leg. Now let's go and look for a couple others. What do you guys see here? So this is our SMR zone, right? Every single profile that I showed you guys, if I show it to you on chart, I'll be able to show it to you in hindsight this easily. Every single profile is this easy to spot on charts. So do we have a fair value gap here? Yes, we do have a fair value gap. Where's my horizontal? Yeah. Now let's see what price did here. So this is an old SMR zone, right? What do you guys see here? We extended out on time. Price didn't even reach here, let alone close the candle's body. But here, price did close the candle's body below, right? So what do we expect? Price not going up and closing any candle's body above, right? As long as price not coming back up and closing a candle's body above, as long as price is closing its candle's body inside this inversion, we can expect to see bearish delivery. Now this on 4 hour chart, folks. This same thing repeats on 1 minute. Okay, does it make sense now? So what do you guys see here? This worth way more than fucking $80. Trust me, it worth way more than $80. Okay, all the information that I'm sharing. Then here again we have our SMR right at this level. What do you guys see? Did price close the candle's body below here? No. Now price did close the candle's body below here, right? Once price did close the candle's body below, what do we know? The price will continue its trend lower. What do you guys see here? Now let me show you guys another example. What do you see here? This is a choppy price action, right? Anyway, I showed you guys a couple of examples on higher time frame. Right now, I'll take you guys on the 1 minute chart. Before I do close the session, I'll take you guys on the 1 minute chart and we'll see what's happening. Just a random. This is not even inside macro. Okay, so we have our SMR zone, the smart money reversal, right? This is where price continued higher. This is our fair value gap from SMR. We wait for price to close the candle's body below, right? Price did here. Now we know price will continue its trend lower. Now price came back up again. How many times did price use it to get support? To get resistance lower? Multiple times, right? So now what I showed you guys here is, now that's a stupid question. I don't use any indicator. The indicator that I use is like new week opening gap to spot new week opening gap and new day opening gap. I don't trade with any indicator or anything. In my charts, there's no indicator. It's pure logic with price. So this is it, folks. This is our day 2, and trust me, if you go on your own chart and look for these market profiles, you will easily find it. Okay, I'm not gonna do it for you because that's something that I consider as a mentorship level, and this is not a mentorship. So when I do open a mentorship, you'll see me doing a lot more than what I'm doing here. Okay, there are a couple more profiles. How many profiles did I show you guys? 4, 5, I think 7, right? So 7 profiles. There are 10 to 12 more profiles left, and that's what I'm gonna cover in my mentorship. So this is the end of day 2. Our day 3 lecture will be on 5th of November, and there I will cover turtle soup plus couple more inversion models. Okay, folks. So I hope to see you guys again in day 3, in 5th November. Okay, folks. The time is yet to be decided. I'll let you guys know if I'm doing it in morning or in the PM session. So this will be it. If you guys have any question, you guys can email me or text me in the private Telegram group. I'll try to get back to you as soon as possible. Take care, folks, and peace.